All right, recording on. Today is Wednesday, July 26th. We're now in week 3 of our class. As we get started today, just wanted to open the floor to see if there were any questions about anything so far or comments, concerns.
Professor, I have a question about the group project, I guess,
Yes.
the group effort. When are we at a point where we should start working on that, or we don't need more content in the class? You're going to kind of give us a go ahead, like, hey, week whatever, we should really start jumping into this now, or can you give a little guidance on that?
Yeah, that's a good question to kind of kick us off. So as a reminder, the last week of class, which will be week 7, you will be doing presentations on a company that each of your teams you've been assigned to group projects will have selected. And you'll also be grading other teams as part of the process, as well as I'm grading your team on that presentation. So this week, we were going to, so I'll bring it up now, start to select the companies that you want to analyze and present. So each of the teams, and just as a reminder, all right, hold on. It's not letting me share my screen for some reason. Thought I had the security setting changed last week. Be right back. Sorry about that. For some reason, the security setting on my Zoom reverted to not being able to share the screen. So let me try this again. There we go. So here in Zoom under people, these are where your teams are, and everybody has been assigned to, oh, sorry, it's 5 teams, so 6. 5 teams, 1 of 5 teams. So again, you can just expand these if you haven't already looked. So basically today, each of these teams needs to choose a publicly traded company, so just a big one, that you want to present on that we're not covering in class. So just as an example, I'll talk about Starbucks here in a minute. We'll talk a little bit about Costco and Walmart, so those are off the table. But if you want to pick another publicly traded company, just let me know, and then I'll change your team name to be that publicly traded company. And that's what you're going to work on for your group project. And so the idea would be that each week of the class, we're kind of doing a different theme. First week, we did a little bit of EIC. So you would do an EIC analysis on that company as part of the group project for your final week. Secondly, you would have to do a historical analysis, putting it into the CFI and ROIC tree format that you just did for this week, and talk about that. The next weeks, we're going to be building the valuation model. So you'll do an enterprise DCF valuation with a buy, sell, hold opinion on the company that you have selected. And then the last week of class before the projects, we're going to get into multiples analysis. So you'll do a multiple comparable analysis, which will compare to the DCF and against a couple peers and explain why companies are trading at premium or discount that you made the buy, sell, hold opinion on. So those are kind of the four major themes of the class. Those are the four major parts of the project that you're going to be delivering in that last class. So the other question you had asked is can you start? Well, technically, you can start now, meaning, let's say you told me I want to do Nike, so, or Under Armour, or somebody like that, or Lululemon. So basically, I'd assign your team to Lululemon. Everybody's getting a different company, and you can already start on the EIC and the historical part of that analysis. So you don't have to wait till the end of the semester. Kind of as we're going through these assignments individually, work on them as a group. Does that kind of answer the question, or any further clarifications needed on that?
Yeah, that answers it for me. Thanks.
Okay. But again, it goes back to these 5 companies. Talk amongst yourselves. Let me know. You can text me during class. You can text me after class. You can email me. But each of you needs to pick a publicly traded company you're going to do the analysis on. So this is the week where you can start those picks. First come, first serve. Any other questions before we get into this week's content and assignments?
Professor, for the CFI and ROIC tree for these companies, where are we going to be pulling the information from? I know you gave us a simplified version of the income statement and balance sheet. How are we supposed to approach that?
So I've made some comments based on information that I was given that may or may not have been 100% accurate. So long story short, over the past couple of weeks, this is part of the answer to your question. Over the past couple of weeks, I've made comments in class that this is the advanced finance class, and most of you are finance, concentrations in your MBA. And a few people have told me that that is actually not the case, and that you were signing up for the advanced finance class, not thinking that it was like advanced hardcore finance, but it was kind of like the valuation class that was available. And so in that context, what I think I'm going to do is make your lives we're not pulling back academically too much on this, but make your lives a little bit easier on building these models. Meaning in some versions of this class, I kind of help people by giving them some models to work with, and then they kind of continue building. And this semester, I was going to make you build everything from scratch. So I think we're going to go down the alternative plan, which is to kind of give you some models that you don't have to start completely from scratch on, and that you can work on. Still academically, you're going to do some stuff and understand some of the modeling aspects, but it'll be something a little bit more accessible, I think, for a few members of the group here. So the answer to the question, which is going to be what we're going to start covering in class today, is that I'm going to help you with the core data that you'll need for the companies that you select, as opposed to telling you to go get the data yourselves. So basically, once you've identified the companies, and you'll see examples of that as we go through class tonight, I will give you the data on the companies that will help you build out the work that you need to do. So I'll help you with that part of the process. So I'll create a files folder for each of your teams with a company name on it, and then I'll start putting the data in there that will help you. So for example, we do EIC, I'll give you the screenshots for Bloomberg, so you don't have to worry about trying to figure that stuff out.
That answers my question. Thanks a bunch.
Sure. Any other questions? All right, so going into tonight, a couple things. One, here, let's have the screen shared. Under files, under lecture notes, we are going to be going over lecture 3 a little bit later tonight. So you might want to grab that PDF and download it. And then here under the week 3 tab, I put in a solution to both Costco and to Walmart. That's these 2 files, which are now available. Okay. And that's where we're actually going to start tonight with this week's homework assignment with this solution. Okay. So let's start out with Costco. Let's see. Share. Open up the Costco solution. All right. So this is, I know you guys hopefully built what I'm kind of helping with the solution here from the homework assignment. But this is where, as I said, I'm going to also, starting this week, provide an assist, which is going to set up our building of our valuation models. So what you did this week, and I'll start with Costco, is your file had the income statement and balance sheet in a standardized format. And your goal was to basically create this ROIC tree and this CFI through free cash flow. I wasn't asking you to balance it, okay? But just to at least get through the free cash flow on the CFI statement. That was the homework assignment, which we are going to cover. In the solution file that I'm giving you, which covers everything that you turned in, it goes a little further. So on the CFI, it fully balances the CFI with formulas. So you can see where everything came from to check both your solution and to see the rest of the CFI. But also, this income statement and balance sheet is auto tied, which is what you should have done, to the TFI, TII, and CFI from these standardized income statements and balance sheets. Okay. What's an addition in this file is this tab called model data. So what I do, because I use Bloomberg and have access to it, and especially the other classes as a data source, is I download sort of a raw data feed from Bloomberg for any company, in this case, Costco. And it just comes in kind of row by row here of historical data. Okay, not necessarily tied to a statement, but it's all the things to make a statement. From this raw data, I've created this standardized income statement and balance sheet, okay, which is basically where you started. So in order to do the assignment that you did this week, I took the raw data from Costco and I gave you the standardized income statement and balance sheet, okay? But what you'll see in this version of the file, because you didn't have the raw data, is that the links are here. Like in your file, you only had a number for revenue, 129,025. But in this file, that is the solution. If you click on it, you'll see that that's coming from model data 6, and model data 6 is row 6, which is the raw feed of the revenue that is coming for Costco, right? And the advantage of the solution that I'm giving you is that if we had another company, Lululemon, then I would give the raw Lululemon file, I would just basically overwrite this tab with the raw data exported from Bloomberg, and then the entire model would immediately update. And it would have all the historical data mapped, including all the historical TII, TFI, CFI, and ROIC tree. So it happened instantaneously. So that's where we're going to go slightly differently in the next 2 weeks, is that originally you built it all yourself. I was going to have you keep building it all yourself without giving you the formulas. Here, as part of the solution, I'm giving you a template that does what you did this week and goes further. And so it's essentially a reusable model. So your choice, like if you want to keep building the reusable model that you built, you're welcome to do so. You just have to tie in the raw data file to it. Or starting with next week's assignment, you can start using this file, which kind of does what you did plus more. And again, it's kind of a reusable file to make it a little bit easier. Sorry, Kathy, you have your hand up?
Yeah, question. So I know you pull this from Bloomberg. Is this file like formula based where it refreshes when you load Bloomberg?
It does, but you don't have Bloomberg, so yours won't be dynamic like mine is.
Okay, would you mind sharing the one that you have? Because I actually use Bloomberg at work sometimes, so this could be good for me just on a side note.
Yeah, so what, just for everyone's benefit, what she is talking about, here's Bloomberg. And if you go to a company like Costco in Bloomberg, there's something called FA, which is historical statements. This is where they have all the historical statements for a company. And over here on custom, you can create your own custom templates for historical data. And I have a custom template, which I can share with you, called model. And so basically, this is all of the income statement and balance sheet data for the last 6 years for any non-bank company. And so basically, it is this file, which exports to Excel, which then feeds the model that we're going to use in class. So if I switch this from Costco to Lemon, then here's 6 years of Lululemon's raw data, export it, put it into our first tab of our file, and now our file would have Lululemon, and this entire process would take less than 5 minutes. So that's the idea, is that we're building a reusable model, and that's going to be key to what we not only did this week for historical data, but what we're going to do for valuations as well. That's part of the advanced modeling. So the answer to her question, Kathy, is yes, I can give you this part of the template. For the rest of you, since you don't have access to be able to do this yourself with this data service, then I will give each of the companies that you select, I'll export that data for you. Okay. But here's the thing, whether we use Bloomberg, whether you use another data service, you could actually use another data service and basically create your own data that feeds the income statement and balance sheet. You can model that out. So the one I'm showing you is modeled off of Bloomberg as a data source, but you don't have to use Bloomberg as a data source. You use any data source. But that's the whole idea, is that when you do valuations on Wall Street, ideally you want to use reusable models. So you don't have to manually type in some things that are tied to these data sources. Hopefully that clarified things, not confused things. Questions about conceptually that piece? All right, so let's talk about Costco. So back to Costco and our model over here. You should have created the top half of this tree as part of your homework for this week. And one of the reasons why I asked you to do Costco is, as you were building the ROIC tree off of your TFI and TII, you should have used the operating data. And I gave you Costco because in the lecture notes last week, Costco solution was in there for the first 4 years, meaning these 4 years you already saw and you had the answer to in the trees that I gave you last week. So for Costco, if you were just building your own solution, you could have checked to make sure that your data synced to my data. And really it was about figuring out 2022. That was the only new information, because otherwise you're kind of recreating the historical data. And then if you did Costco first and got it right, then it'd be easier to do Walmart, which I would have done secondly. But nonetheless, this would have been the tree that you should have created for Costco. And the key in your tree is to identify the operating elements of the income statement and the balance sheet. And so that goes back to TFI. Like what you were doing here is you should have figured out what is your operating invested capital, which is the operating working capital, the long-term capital, which is the property, plant, and equipment, and the goodwill and the intangibles. And then that would have been your operating invested capital. And then the other piece of it would have been to figuring out the operating income, which is if you did in TII, which was been your EBIT, tax affected, and then got your NOPAT, which is the after-tax operating income. And that would have helped you get the ROIC, because it's that NOPAT divided by that invested capital, which is that ROIC. So before we talk about the interpretation of this tree, questions about building the tree itself. Hopefully I was able to successfully do that. Do you have any trouble matching the numbers? Any issues with what was operating?
So I had a quick question. So we were going over, you provided to us, I guess in the first week, when we were looking at long-term assets, long-term liabilities, you were identifying them as operating or non-operating. And this week, we didn't have that distinction. And so is there a default? What should we assume if it's not identified?
Well, what I did give you, if you go back to lecture 2, which I'm going to do, share files. Under lecture notes, in lecture note 2, put the PDF real quick. We didn't directly cover it as in class, but as part of this file. Where was it? I think I put it.
I mean, I believe it's in there. You don't need to show it to me. I'm just
So-
curious what your guidance is. That's all.
Yeah, oh, here it is. It was this. So I kind of gave you a slide that talked about the things that are generally in the categories. But I guess that's the trick, meaning when you deal with financial statements, you have to kind of decide, what do I believe is operating? What do I believe is non-operating? What do I believe is interest-bearing debt? What do I believe is equity? And so that was part of the exercise that I wanted you to kind of think through this week. This would have been sort of a guide based on what the book does on what's generally in those categories. And if you had followed that, that probably would have helped you with this assignment. And, that's why I go back to the standardized statement. Like in the standardized statement, if we put it in a standardized format, if you label inventory as always being operating, then it will always be operating. And so really it's just figuring out a few of the categories, whether they were operating or non-operating. And so that's why I wanted you to kind of at least think about it, but here would have been some of your thoughts on what to look for. Does that kind of
Okay.
make sense?
It does.
Or were
Thanks.
there any specific categories that you were struggling with or had?
Yeah. So long-term assets and liabilities. I mean, I wasn't sure where they belonged. Took a guess and got it right. But I mean, it didn't mean that I really understood. I mean, I had my own instinct about it, but I was just. So I appreciate what you're saying. What you're saying is it's an art form that it's not always identified in the documents, and you take your best shot at it. So I get it.
Well, there's 2 levels of that. There's and so to be honest with you, this is just, now we're getting into like the real world practicality of this, meaning you see something like other current assets, right? And then you have to say, okay, is that operating or is that non-operating? You can make a judgment call as we're doing here, looking superficially at statements, but the honest answer is when you get into these sort of other categories, like you either have to do one of 2 things practically. You usually need to go down to the footnotes and you start reading the footnotes to see, all right, what does other entail? And then you have to make your judgment on, based on what it entails, does that sound like it's an operating item? Meaning, is it something that every time they sell a product, they're going to have more of? Or is it non-operating, which doesn't seem to be tied to the sales of the business? And then you kind of make your judgment. So that's one way to do it. Second way to do it, and practically, is you talk to the company themselves. Like as an analyst, you'll talk to a controller and you'll say, hey, controller for Northrop Grumman, help me understand these other assets. What's in here? What's their behavior? And because the company itself kind of knows, they know, internally, their accountants, they kind of have a good sense of like, these are the things that are operating. These are the recurring expenses that we make as normal course of business. And these are the ones that don't. And sometimes they'll put both into another category. And so you might, need to, if you had the granularity, be able to split it out. Now, it's not as easy to split it out in the outside, but nonetheless, that's ideally what you want to try to get to. So I don't want my answer to sound like a cop out that, when you do this, it's not as arbitrary as you think, but at the same time, it does involve a little bit of digging, because what one company might call an other current asset and put in there might be different than what another company calls another current asset. And so, for example, one company might do an operating item, and another company might do a non-operating item, like like a credit card financing scheme or something like that. So you have to figure out what they're actually doing in the real world. But for purposes of this assignment, these are generally what we tend to see. So that's where I was leading to you with my solution, and where the slide was coming from the book.
All right, thanks.
Sure. Any other questions about the mapping? Okay. And then the last part before we get into analyzing the trade, does everybody understand why we're doing the mapping? So let me ask you, why are we doing this mapping? Somebody tell me that. Feed that back to me. Why are we going through this exercise again?
To identify operating invested capital,
And why is that important? Yeah,
because we want to do our ROIC on an operating basis.
that's one of the reasons. And what else? Why else are we doing this? So a couple more hands. Maz?
So that we can identify key drivers like first level and second level, like what's driving your ROIC? Is it productivity, or is it like more of a gross margin or operating margins?
Yeah. So, so that's going to be one of the things. It's going to help us understand the first and second level drivers of what's operating, but it's also going to help us understand what's operating, what's not operating. So again, just conceptually, if you go back to that chart that was in lecture note 2. Let me just go back to that in the interest of what we were talking about. The whole idea here, kind of see it right here, is that when most people do return on invested capital, or ROIC, what they're doing is they leave all of the assets in the calculation. In fact, that's the whole point of what this slide says, is that what most people, I call it traditional ROIC, is it's assets minus the non-interest bearing liabilities. And they don't bother to look at the operating assets and the non-operating assets. They just bundle them all together. So that's the whole point I was trying to stress last week, is that what you're really doing is just getting kind of a return on the average performance of everything of the company. But when you click down, you start to realize that the operating and non-operating have different rates of return, and they tend to grow at different rates. And so that's actually the other thing that we're trying to get an understanding of, because we're going to forecast the operating and the non-operating separately, and we're going to forecast growth of the operating and non-operating separately. We're going to eventually add them back together to get the average value of the firm, but that's the point. The firm isn't going to grow at an average if those two pieces below it grow at different rates and have different rates of return. So that's the reason for the granularity of this process. And so if we don't have a way to categorize operating and non-operating, then we're kind of stuck with the average of the firm. And what I'm just saying is, over time, for most companies, what they're doing today doesn't grow at the same rate forever as the same weighted average. So that's why we're actually going through the other step of the process as another reason. Okay, so that's what you've done. What you've done is, this week's homework assignment is, you've taken the income statement balance sheet, you put them into operating and non-operating, TII, TFI, and you've created the cash flows, operating and non-operating cash flows out of that. And then for purposes of the analysis, first thing that was mentioned is, now we're going to do the click down analysis of Costco's operating performance over the last 5 years. So that's the top of the tree. And so what we can see for Costco, based on the solution, is that their ROIC over a 5-year period went from 20.4% to 26.5%. And it kind of went to 26.5% in the pandemic in 2021. And the level of performance between 2022 and 2022 didn't really change that much. So they're kind of like at the top of their game the last 2 years based on where they've been over the last 5 years, but they've improved over the last 5 years. And then the second part is then, all right, first 3 reasons. Why did they improve? Why they go from 20% to almost 27% ROIC? The first driver was the tax rate. 2018, they paid 28.4% in taxes. 2022, they paid 25% in taxes. So they're paying less taxes. So paying less taxes, lower tax rate, basically means an improvement to ROIC. So one of the reasons why the ROIC went up by 600 basis points is that the tax rate went down by about 4%. So that drove up the ROIC. But again, as we look at the second and third level drivers, it wasn't the only reason. Second reason is we see the pre-tax ROIC also improved, which suggests that the underlying business got better. More people were going to Costco. 28.5% ROIC in 2018, 35.2% in 2022. And that ROIC was steadily improving every year, right? And so the question is why? What was causing the pre-tax ROIC? Well, there's drivers 2 and 3. First part of it is, are they making more money when they sell a product? Slightly. They were making 3.2 cents per dollar of margin pre-tax in 2018. Now they're making 3.4 cents per dollar. That's actually one of the reasons why I stood in a long line at Costco last week and have been a member for all these years, is because the bond they have with their customers is they give you consistently low prices and they have very consistent margins. So, you know, if you go into Costco, that you're going to get a reasonable price on something at a reasonable margin, and that margin just hasn't changed over time. They're very consistent with the markups on their merchandise. And as a matter of fact, the other retailers complain that they could be charging more for some of the merchandise that they sell in their store, but that's not their strategy. Their strategy is to basically give you a fair deal and drive more volume. So their margin is very, very consistent. You can see that here in the tree. So the real question is, if the margin's so consistent, how did the pre-tax ROIC improve? Well, you can see that's the third driver, is that they got more efficient. They are getting more efficiency out of their stores. And I can tell you that the lines in the checkout line pretty darn long. And I've never been to a Costco that's not jammed. And that's the point. Like, they're getting much more store productivity right now. So that's the point. At scale, they're spending 11 cents per dollar of invested capital of sales in 2018. Now they're only spending 10 cents per dollar. So a little bit more margin, extra 1.3 cents per dollar of invested capital sales productivity. That improved the pre-tax ROIC from 28% to 35%. And so that's what you guys should have been able to see. And hopefully, when you were doing your write-ups, explain about Costco, that really it's 2 things: lower tax rate, and it's a productivity story. That's what's driving their improved performance with fairly consistent margins. That's the first level analysis. And then when you click down, okay, fairly consistent margins, did anything change here? Well, the one thing that changed is their gross margin went from 14 cents to 13 cents. Right? Gross margin is basically the difference between price and cost of goods sold. So they're either lowering their price or the cost of their products are higher. If I had to guess, given that we've been in an inflationary environment the last year or so, I bet Costco's costs have been going up faster than their prices, right? And so that's the point. They're having some pressure on the markups of their products. How have they manifested to overcome that? They've gotten more efficient if they're spending and operating. They're spending 9.8 cents per dollar in 2018. They're at 8.7 cents per dollar of SG&A. So essentially, they've gotten more efficient on their overhead to offset some declines in the merchandising profitability. And the depreciation stayed about the same. It's about 1 cent. Got slightly better on depreciation. But really, the operating margin didn't really change. But what did change is right here. These 2 things did change on their income statement. And that's important to note. Is everybody seeing what I'm talking about? Did you guys talk about these things in your write-up? As drivers?
Professor, really appreciating you walking through it again. But I was curious, do you have any, or can you help us develop a sense of which of the drivers is more impactful relative to each other?
Well, as I said, that's why I wanted you to build the tree, but this minus this minus this equals that. So to some degree, all three of these feed operating margin. Now, for a company like Costco, so it is somewhat relative, depreciation is so trivial. It's 1 cent per dollar relative to 14 cents per dollar, that a change in gross margin probably has much more of an impact than a change in depreciation, just because the depreciation rate is so low for a company like Costco. So that's the point. Like, this 1% drop in gross margin is the entire 1 cent of depreciation of Costco. So even though on a percentage basis, this went down by 17% as an impact, it's pretty trivial compared to what's going on in the gross margin. So that's the point about retail. Like, that's the other thing to start to see. They're not making a lot of their products. I mean, think about what a 13% gross margin means. If you go in and you buy something that's $100, that means essentially $87 is product cost. And they got $13 left. And then they spent $9 running their warehouse, and they spent about a penny on their warehouse. That's their business model. So changes in gross margin, because it's so low as a retailer, since they're spending so much on product costs, and it's the big portion of where they're making their money, are very important in the retail business, right? And that's why the other part is they got to manage these other costs. So these three things in context affect that. But it could be different for a different company, because you might see, for example, and you will, if we look at another company, like if I were to show you a company like, take one here that we did in a different class. Point.
That's definitely helpful though, because I was thinking of it as, I think I was giving too much weight to the percentages, whereas the actual amounts are arguably more important, it seems like.
Yeah, so I'm going to pull up a tree for a company called Royal. Actually, no, this one screwed up. Let's not use that. Let me see if I have. Find a non-retail company. Bear with me for 1 second. Here we go. So let's say that I give you a company like Dentsu. Where's Dentsu? Nope. Don't show you Dentsu. Nike in here somewhere. Here's Nike. So this is Nike's ROIC tree, but what you'll see is their ROIC is higher than a company like Costco. It's around 45%. last year. And if you kind of go over here on the tree, their operating margins higher, 14%, right, versus 3%. So you buy a pair of Nike shoes. Like I said, they're making a lot more money in their shoes than Costco is on selling their products. But it's also a different margin. Like the cost of a Nike shoe is about, 52 cents on the dollar. So you buy a $100 pair of Nikes, they're probably spending close to $50 on the actual shoe, right? You go in and you buy, something at Costco, they're spending for $100, they're spending $87 on their product, right? So the markup at Nike is just completely different than a company like Costco, right? But the flip side is Costco spends 8 cents per dollar on SG&A. Nike spends 32 cents, right? Because they're spending on marketing and branding. Costco doesn't spend on marketing and branding. They're spending on R&D. They have whole R&D teams, right? Did you watch the Michael Jordan, what was the Air movie on the Air Jordans? I mean, that's the whole point. Like all those people that are building the shoes and marketing, they're very, very expensive and they're very high priced. And Nike's very good at that. And so they're spending that, but that's the point. High SG&A leads to a high gross margin. All right. Neither one of them spend, Costco or Nike, on facilities. They're spending $0.015. Costco's spending a penny. But the two differences here are dramatic. So that's why I go back to it's not necessarily the same for any company. You're going to see some industry and company differences, but conceptually, these three things still explain an operating margin. And so at Nike, you're getting a much higher margin markup on the merchandise, much higher spending in SG&A, but the net of the two still gives them more profit. So this is very productive. The flip side is, given Costco's low cost strategy, you can see it when you look at the Costco data that you just put together. Let's go to the Costco model. Because they have such a low gross margin, they can't afford to spend much in overhead. I mean, if I make 13 cents from the sales of my products, I can't spend 30 cents on SG&A. It just wouldn't work as a model. I would just lose too much money. I wouldn't be able to survive as a business. So they have to keep their costs low. That's why you're walking into a warehouse when you go into a Costco, right? And that's the point. They do everything they can to keep their expenses low because their margins are so low, right? Different story for different types of firms. Does that make any sense? Was that somewhat helpful in your question?
Definitely. Thank you very much.
The other story for Costco was the invested capital sales. And like I said, they got more efficient between 2018 and 2022. Most of the efficiency happening in the first couple of years. So, they didn't really do acquisitions at Costco. So your intangibles would have been zero. And so really, where are they improving? Well, they had negative 3 cents of working capital, negative 2.3 cents of working capital. Ironically, working capital got worse. When you go from more negative to less negative, that means you're spending more money. So working capital actually worsened. So Costco is a story of the warehouse productivity. It's PP&E to sales. Went from 13.9 to 12.1. And as I said, anecdotally, what I go back to is, I think it's the amount of people and the stuff that go to Costco. They're selling more at every warehouse. I'm saying, I remember lining up in the pandemic to get into a Costco, but I'm just telling you, today versus even 5 years ago, every Costco I've been into, the amount of people in there seem to be more. There's more people buying more stuff out of the same stores. And that's manifesting itself in PP&E sales going down. Same store sales are basically going up. And that is why their ROIC is getting better. They're not getting better because they make more money in their products. That's actually the thing. I think inflation's actually cut into their margin and they've had to do some cost controls. They're making money based on productivity. And in this inflationary environment, I think it's correlated. Why are people going to Costco? Because people know that they can save money by going to a Costco versus a more traditional store. And so that's kind of fed into the way that their business model has been successful. But nonetheless, this is the data that comes out of it. So those should have been a couple of the insights. Now, you probably wouldn't have talked about the anecdotal stuff to the business world, although that's what you should start to try to do, is to link numbers to decisions, because these decisions are results of the business choices that companies make, right? Decisions lead to results. We're seeing the results, we should be able to work backwards, right? But nonetheless, we at least have to understand how the puzzle is put together. And this is the ROIC tree for Costco. Pause, questions, comments, concerns, crippling fears. All right, so assuming you got Costco, then Walmart should have been a breeze because it's the same structure, right? And so assuming you did Costco, you should have been able to get the Walmart thing done. So I'm going to pull up the Walmart tree. I'm going to pull up the solution. And I'm going to let you guys tell me what's going on with Walmart. Talk to me about the first three drivers at the top level. What's going on with Walmart? Adam?
So Walmart had about a 7% decrease in ROIC, primarily contributed by the reduced operating margin. Their tax rate did decrease by 10%, which helped them, and they became more efficient by 11%. But that operating margin really killed them.
So be specific about the operating margin. I just think it's important.
The operating margin, their operating margin decreased by nearly 22%, which at a company like Walmart that has rates within margins as it is, that really decreased their return on invested capital.
Yeah. And so on the click down, what happened that caused their operating margin to go down 1%? Either Adam or somebody else. All right, Patrick.
Their gross margin fell
From to use
from
from to.
27 cents to 25 cents dollar sales.
Okay, so they lost about 1.3 cents of gross margin. Did anything change about their overhead? The SG&A?
It seems like they're controlling that really aggressively because it seems like unlikely that with a 20-ish% increase in revenue that they would have exactly like the same SG&A that whole time, but
It did, yeah.
they hung on to it.
So what's the difference between Walmart and Costco then on the income statement, on the operating margin? What's the primary difference between the two?
Costco was able to decrease that SG&A where Walmart really kind of maintained it.
Yeah, and financially, that's why Costco probably outperformed Walmart over the 5 years, because they were able to actually reduce their operating overhead. Walmart wasn't. So you're right, Walmart was consistent like a clock in their spending. All right, so the problem is, and again, I think inflation hit all these retailers as their costs went up in their supply chains. They weren't passing along, just like Costco wasn't. The only difference is Walmart wasn't changing how much they were spending in their stores. Costco got it down a little bit. And so, you know, Walmart got hurt more, as you just said, in their operating margin, which really hurt Walmart's ROIC over 5 years. Costco, because they got more efficient in their SG&A, was actually able to improve their operating ROIC over the 5 years. So little tale of two companies here when you kind of put them side to side, and some differences of what's going on in their income statements. Everybody see that? Now, is Walmart getting more efficient? Over the 5 years? Looking at that third driver.
Yes.
Okay, so say more.
Yeah, they're basically reducing their invested capital by 11%, from 26 cents to 23 cents. indicating activity to generate $1 worth of sales.
And where was the efficiency coming from on the second level?
Mainly due to property, plant, and equipment, that it reduced 9.9% from 21 cents to 19, as well as a reduction in intangibles of 12%.
Yeah. So the first thing is Walmart has done acquisitions where Costco really hasn't. And it does appear that they're getting essentially a little bit more proficient, not only in their stores, but they're also getting a little more effective at the acquisition spending, which basically means, intangibles either go down because you write it off or because you sell more for the same amount of goodwill. But either way, they were getting more productivity out of their intangibles, as you just said, in addition to more store productivity. So those were kind of consistent themes with what we saw with Costco. As I said, the real difference is Costco got their SG&A down, Walmart didn't. And that was really the tale of the two companies as to why Costco's ROIC improved and Walmart's didn't, because they weren't able to make up for the loss of margin with their productivity. Costco maintained their margins at the EBIT level while improving their productivity. And that was the difference in the ROICs. Does everybody see those storylines? Questions about this? Make sense? Okay. Since we're on Walmart, what was going on with their cash flow? Now, for your purposes, I only asked you to do free cash flow, which is gross cash flow minus gross investment. I don't have a total line in here. So I'll just add one very quickly. If I sum these 5 years, side there. What's going on with their free cash flow? Chris?
So it actually looked like for both Walmart and Costco, they had periods where they invested significantly in capital expenditures that were followed sort of the year directly afterwards with significantly improved free cash flow, but it was in both cases it was temporary as opposed to lasting. So they only really saw those benefits the year after, and in both cases they kind of stopped that, or at least sort of reduced that capital expenditure the following year. So for Costco, it was for Walmart, I think it was primarily in 2019, and for Costco, it was primarily 2020, where the investment came, and then the year after, they had the improved cash flow.
So why do you think both companies saw a slowdown after some initial expansion in CapEx? What do you think was behind that? Because it probably occurred in 2020, 2021. Why the slowdown?
I guess once you make that investment, like you probably only periodically do that, but then you're also looking at sort of the consumer trends and other bigger factors, and you're kind of playing it a little bit safer based on macro variables.
What consumer trend would have caused them to play it a little safer in 2020?
Well, pandemic.
Yeah. And you could see it. Like they were both aggressively expanding right up until the pandemic. And then when the pandemic hit, they slowed down. Both of them slowed down on their investments. Although interestingly, as we're getting towards the end of the pandemic, post-pandemic, wherever age you want to call us in now, notice Walmart's spending is going back up again. They're once again on an expansionary track, because now they're spending 160% CapEx to depreciation, and the CapEx is up to almost $18 billion last year. Not as much as they're spending in 19, but definitely much higher than they spent in 2021. All right, so the other side of the equation would have been, okay, and this is important because, as I said, practically, most people don't do the rest of this statement in the real world. And I think there's value in doing it. Hopefully you'll start to see the value in doing it, because balancing isn't just because it's the academically right thing to do. I think balancing is instructive because it tells you what people did with the cash. And in the case of Walmart, it generated almost $59 billion worth of free cash flow over a 5-year period of time. So the question is, what did Walmart do with all that cash? Where'd the almost $60 billion worth of cash generated from operations go, right? Which was a pretty big number. And so that was the point. If you look at the non-operating activities, well, they had about a $10 billion loss, some non-operating thing that they did, right? They increased their non-operating assets. They bought about $1.7 billion in non-operating assets. So basically this, and then they did make some interest income and had a slight decrease in their excess cash, about $1 billion to kind of offset that, but about a 10 billion drop, $10.6 billion drop when they got to the cash flow available to investors, because it was chewed up in non-operating losses primarily. And so they had 48 billion to distribute after the non-operating losses. And so where did it go? Well, they paid almost $7 billion worth of interest, about $1.2 billion, $1.3 billion every year. They increased their debt by $17 billion, which should seem like an outlier. Like, why are they increasing their debt so much when they have all of this cash? I think it kind of comes down to here: 30 billion in dividends, $35 billion of share repurchase, $65 billion of cash they returned to the shareholders, and they only had 48 billion to do it. So they borrowed the difference. And that was a recurring trend of a lot of companies during the era of low interest rates. Because they were basically, hey, if I can go borrow 2-3% all-time low, why not take advantage of that? And a lot of companies did. And they used that debt to basically reward the shareholders. It was kind of a recapitalization of their balance sheets to try and manage their WACC and to improve their performance of EPS. But nonetheless, clearly Walmart was one of the companies that did that. And you could see that right here in the CFI. But that's the point. Like, I generate all this cash. What did I do with all the cash? That's the other reason why we balance. Does that kind of make sense? Questions? You're able to follow that? I know you guys just did the first part of this. So why don't we look at Costco? We look at Costco. Let's reshare this. And I look at their CFI. Like I said, I'm going to quickly add the total to this. So somebody talk to me about what's going on with Costco's free cash flow. Tell me how they got to the 14.7. Free cash flow over the first 5 years. What's their story? Tell me about the 5 years of historical free cash flow at Costco. What were the insights? Oz?
So overall, I think they generated about $30 billion and they invested around $15 billion. So they were left with around 14.6.
Okay. Any 5-year trends that were jumping out at you?
Yeah, so let me see investment. The CapEx depreciation like around 2020, like the 325%.
Mhm.
That kind of jumped out.
We saw a dip in CapEx at Walmart. Did we see as dramatic a dip at Costco?
No.
Patrick, you want to add to that? Get your hand up.
Yeah, I mean, the biggest difference that Costco had is that they just did so much more revenue in that period of time that it was easy to have more cash.
But they were also reinvesting more, and it seems like that reinvestment was paying off for them. When we kind of combine it with what we saw in the ROIC tree, where Walmart wasn't paying off nearly as much, and to some degree, they kind of slowed in the middle of the pandemic, some of that reinvestment for a year. They paused. Costco didn't pause. Not nearly as much as Walmart did. But overall, they were generating pretty consistent free cash flows every year, from 2 billion to 3 billion, well, 21 being the outlier, 4 billion, but consistently generating a lot of free cash flow. So what'd they do with the 15 billion, almost $15 billion, 14,691? Where'd it go? Again, I know you probably didn't do this part of the tree, but I'm giving it to you. Here's the non-operating items summed. And here is the debt and equity summed. So what happened in non-operating items at Costco? How did 14.7 turn into 10.1 to pay out? What did Costco do with that $4 billion of non-operating cash? Yeah, Isabel?
So they had a decrease in their non-operating cash and then also in their non-operating assets. But especially compared to art, a lot of that.
What does that number mean?
Oh, that's an increase. So that actually, they were able to increase their non-operating cash
Yeah.
as
so
well as their.
They bought non-operating assets and they increased their non-operating cash. So remember, Walmart lost a bunch of things. They've lost a bunch of money here. Costco's not losing money here. Costco's actually buying things and putting more money into savings. Another difference in the two companies in their non-operating cash flows. Everybody see that? But that left them with 10 billion to pay out. How'd they pay out their 10 billion? Where did their 10 billion of CFI go at Costco?
Common dividend,
How much in dividends?
10.4.
So almost all of it went to common dividends. There's their dividend. They paid it all on dividends. Now, how did they afford the $1.7 billion of share repurchase? Because they also paid out almost $2 billion to the shareholders, buying back stock.
They
With
took
that-
out.
This paid for that. This paid for that. There's the point. If they're paying out to shareholders, call that 12 billion. How do I pay out 12 billion if I only got 10? Now, what's interesting is they could have used the cash. Like they had that much money to pay out. They could have theoretically paid that out and not put that into cash. But they did put some into cash because they're like, well, you know what? I can borrow again at 2 to 3%. Why not take advantage of low interest rates? So again, another company that didn't need to borrow chose to borrow to basically buy back stock. CFI. All right. Again, Pause. High level questions about any of this. Does it make sense? We're able to do this. We're able to get to this point.
Can you
Yes.
can you
Go ahead,
talk through the logic?
So a little bit of an echo.
Sorry about that. Is that better?
Yeah.
Can you talk through the logic of, I understand that interest rates were, historically low over the past couple of years, but just realistic, like what is their, what are the impacts now, or what is the long-term intent or goal of taking on debt to pay out their shareholders rather than just and socking away excess cash rather than just using that extra cash they generated?
All right, so I want to answer your question in two parts, but I'm going to pose it back to the group. Question one, which leads to your question. When should you pay out? When should you reinvest? What should be your determination? When should a company pay the cash out? When should a company reinvest the cash? What's the determination? Yeah, Attitude.
Yes, the main determinant of when companies should reinvest is when there are viable investment opportunities,
So be
Yeah.
more specific. What does that mean financially?
positive NPVs.
Yeah. And in the context of our class, what would we call a positive NPV in this class? What words do-
ROIC, increase in ROIC,
versus the what? ROIC higher than the,
sorry, I'm not following.
okay, anyone want to phone a friend? ROIC needs to be higher than the blank.
Cost of
What?
capital.
The cost of capital. So when your ROIC is higher than the cost of capital, you probably want to reinvest. When your ROIC is less than your cost of capital, you don't want to reinvest. Let me say it a different way. I assume everybody on this call has a credit card. Okay. Not everybody should be carrying a balance, but if you do, the average American carries a balance on a credit card. Let's say you're like an average American and you have a balance on your credit card. So you have a credit card, and let's say you have a low interest rate credit card that has a 9% APR. Okay. So you have a balance on your credit card and that card is charging you 9% interest. What rate of return on investment do you make if you pay off the credit card? If you have a credit card with a balance that pays a 9% APR, what's the rate of return? What's the ROI on paying off that card?
9%.
Exactly. And the same is true. What is the rate of return when a company buybacks its stock? What is the ROI when a company buybacks its stock?
The ROIC.
It's not the ROIC. I'm asking, what is the ROIC of buying back stock? What rate of return do you get?
Would it be the delta between the ROIC and the weighted average cost of capital?
If you paid off the credit card, what rate of return do you make?
Is it the dividend rate?
What rate of return do you get when you pay out the credit card? Well, refresh. If you pay off a credit card, what rate of return are you getting?
9%.
And what is the
Whatever
9%? What is the 9% called?
Cost of capital.
If you buy back your stock, what rate of return are you getting? The cost of capital. It's like paying off a credit card. All right. Now I'll be more specific. If you're buying back stock, you're paying off equity. So what you're actually getting is a cost of equity. If you pay off your debt, then you're getting a cost of debt. Okay. But practically, the way you just simplistically think about this is you get your WACC. If I pay back my investors, I get my WACC. Well, what's the investor going to do if they get the money from you that you bought it back? The whole point of a WACC is it's an opportunity cost. And it says for this level of risk, I should earn this rate of return. So if you give me money at 9%, then what I'm going to do is I'm going to go look to make at least 9% someplace else. So why would you want to not give me money? Why would you want to reinvest in your company? What would be your rationale?
If your ROIC is higher than your weighted average cost of capital,
Yeah.
that would make sense for you to reinvest.
And the investor would want you to do that. Because that's the point. Like, I'm not going to do better someplace else. That's the whole point of cost of capital. That's what I'm going to earn for this level of risk someplace else. So if you can do better for that level of risk than what I could earn someplace else, then by all means, keep the money. If I need the money, I'll sell the stock because somebody else will be willing to pay for that higher rate of return. So that's the point. Whether I reinvest or whether I pay out, it's incrementally, do I think I can beat my hurdle rate? If I think I can beat my hurdle rate, I probably want to invest. So that's the first calculation. The second calculation to the question that was originally asked is, okay, let's assume I can't beat the hurdle rate, right? Yeah, my projects earn good money, but if I give the people on this call more money, you can't do much more with it. So I'm just throwing good money after bad because it's not that you don't earn good rates of return. It's just you can't do more than what you're doing. So what I'm going to do is I'm going to take that excess money, instead of giving it to you and hurting your returns, I'm going to pay it out because I don't have good use for that cash. So then the question is, what's the most efficient way to pay it out? Do I choose to pay out the debt holders? Do I choose to pay off the shareholders? Okay. Who do I pay out? Okay. Now, if I'm not in financial distress, generally what Modigliani Miller says is it shouldn't matter. Meaning, if there's less risk of the debt, then you have less risk to the shareholders. If there's more risk to the debt, there's more risk to the shareholders. And they kind of offset each other. So according to Modigliani Miller, it doesn't really matter who you pay off, because if you pay off the debt, then the expectations of the shareholders will come down anyways. So your weighted average cost of capital shouldn't really change that much. If you pay off the shareholders, then the risk of the debt holders goes up. And so therefore they'll charge you a little bit more to compensate for the extra risk of being more debt in the firm. And so therefore the WACC shouldn't change. The whole idea of Modigliani Miller is that whether you pay off the debt or the equity, your WACC shouldn't really change that much unless it causes financial distress. Right? So that's the point. It shouldn't really matter, but here's why it does. In the real world, for publicly traded companies, most senior leaders are basically rewarded bonuses in either stock options, which are based on share price increasing, or driving EPS, which is what will drive their bonuses. Buying back stock helps both. When companies buy back their stock, it reduces the share count and increases the price. When companies buy back stock, it reduces the share count, which increases the EPS. Same earnings, fewer shares, more EPS. That's EPS growth. So basically, over the last decade, as leaders have increasingly been driven to improve their share price, buying back stock is in their self-interest, because it reduces share count and gives you EPS growth, and to some degree can make your share price look a little higher because you have same value, fewer shares, more stock price. So that's why companies like to buy back stock. The other reason why companies buy back stock versus pay dividends, because theoretically dividends are the same cash flow, it's just how you chop it up, is that for whatever reason in the real world, dividends are sacrosanct. Meaning, once you pay a dividend, people treat it like debt. It's like coupon payments on a debt. Like you can't reduce the dividend. Like, I'm used to this dividend payment. You can't cut it. If you cut it, bad things going to happen. Share repurchase is considered one time, non-recurring. So that's the other point. When I raise the dividend, I can't really lower the dividend in the future. When I buy back the stock, I don't have to buy back the same amount of stock every year. So companies also like share buybacks over dividends because share buybacks are treated as one-offs and dividend repayments are treated as continuing. And so I don't want to raise a dividend payment that I can't maintain. That's practically the way things happen in the real world. So that's another reason why. And then there's a third reason why: taxes. If you pay a dividend, generally an individual is going to have to pay taxes at their marginal tax rate. So if you're a high income individual, you're going to pay 30% plus on the dividends that you receive in income tax. If the share price goes up, because you bought back the stock, then I only pay taxes on the capital gain if I sell the stock. And if I sell the stock, the capital gain tax rate after a year is much lower than the ordinary income tax I would pay on ordinary income. Translation, I could pay 10 to 15% on a capital gain in taxes. I pay 30+% on taxes for dividends. Please buy back the stock. Because why would I want to give the government more money? So the government, through its tax policies, has encouraged companies to buy back stock because they tax them at a capital gains rate, which is far lower than the ordinary income rate of a dividend. So that's the other reason why why stock buybacks have gotten more popular. Added Tutu.
I just have a question. Share repurchases, technically, it doesn't go back to the shareholders. It's just retained in the business. So is it really comparable to dividend?
It is. It does go back to the shareholders. So how many people do we have on this call? So basically, we have on this call right now, looking at everybody that's logged on, do a quick count, 5, 10, 15, 24 people. So there's 23 students in this class. Let's say I'm the company, right? And we make $23 in profit, right? So one thing I can do is I can give everyone in this call $1. It's called dividend, right? So everybody gets $1, right? So that's how I distribute $23. Or I could take Gina and I could say, you know what, Gina, I'm going to take the $23 and I'm going to eliminate you as an owner. So here's some cash, go away. So I'm going to buy back your stock. Well, the remaining 22 people now own the company because Gina's gone. So if the company had the same value, then after the 23 is paid out, then basically, or 24 is paid out, now I got 23 people left. 23 people now own what 24 used to own. Each individual's person value has gone up. So in either case, I'm distributing the same amount of cash. So the question is, how am I chopping it up? Do I give everybody the same amount of cash, dividend, or do I give the people that are willing to sell the cash, and then the rest of you just own a bigger piece of the pie that's left? Your value goes up because a person has been eliminated because they no longer own the stock. So again, it has the same financial impact, right? It's a different way of giving you the financial impact. We're just kind of rearranging the deck chairs here. But the value of the firm doesn't change. And you can see that in the CFI, meaning what's the value of the firm? This is what we're about to do this week. I go back to Costco. What's the value of Costco? If I look at the CFI, it's the $15 billion, 14.691 of free cash flow. And whether I pay a dividend or whether I buy back stock, that doesn't change. I have 15 billion to give the owners. That's the free cash flow I generated. How I give you the $15 billion is the question. But whether I give in the form of a dividend or whether I buy back the stock and the rest of you own a bigger share of the 15 billion, I still have 15 billion to give. That's not going to change, regardless of how I pay it out. That's the important thing that everyone in this call needs to understand, is that's the whole concept of operating value. The value of the firm is independent of how it's owned. Okay, so changing that ownership, changing that distribution of cash flow doesn't change how much cash do the operating assets generate. That's the value of the firm. That's the core value for most businesses. Now, some businesses have some non-operating value. So we have that too. And when I put the two together, that's what I can give to the debt and equity holders. But that's the whole point. The operating and non-operating value are not impacted by what the dividends are. So I can make this 0 and I can make share repurchase 12 billion. That doesn't change that. That's the whole point. You can see mechanically how that's working. A lot of people don't really understand this in the real world, but that's actually what's going on when a company actually distributes cash. They're taking that cash and they're giving it to one of these stakeholders. So then the question is just, what's the most efficient way to give it to the stakeholders? That's a separate question than how much cash do I have available to give to the stakeholders? Which goes back to what am I trying to do? If I have positive spreads, this gets bigger. If I can earn a return on investment greater than my cost of capital, this will get bigger. And then I will have more cash to distribute because I will generate more NPV, which will give me more operating value, which will be independent of the payout. But more operating value equals more theoretical payout. That's what you guys need to understand conceptually, because that's what's leading us right into the valuations, because that's how we're going to understand the values of companies. Questions? Does that help answer it? Your question? Make sense?
So Professor, couldn't the company just turn around and give the shares that they just purchased to their own employees?
Sure. But if you're giving it to the employees and you got 15 billion and I give $1 billion to the employees, who'd I take the billion away from? Who can I give the 15 billion to? And I got 13.6 billion. So who's now going to get 13.6 billion versus 14.6 billion? Is the shareholders. So if I give it to the employees, I got 14.6 billion to distribute. And if I give $1 billion of that to the employees, that means I have less money to give to the shareholders. So why would the shareholders be happy that I did that? Why would I want to give it to the employees? What would I have to believe?
That's going to motivate them to be more productive.
Which is going to raise this number. That's the whole argument. I'm going to make the employees more motivated and tied to the business so that they will give me more free cash flow in the future than I otherwise would have got. Because they're going to think and act like an owner. If I buy that, all right, maybe I'll let you see that. But as a shareholder, if I keep giving money to the employees and the business is getting worse and worse, why would I want to keep giving money to the employees? Give it to me. Give it to me, the owner. I'm the one who's entitled to it in the first place. So that's the point. It's how you distribute. And so how should I distribute? Well, if I can give it to the employees, it's called reinvestment. Reinvestment in the business, like reinvest in invested capital. Own more stores, buy more planes if you're an airline. Why would I want to do that? Why would I want to be UPS and give more money to the Teamsters? Because if I didn't do the Teamsters and we went on strike, I think part of the calculation is the cost of shutting down will lower the free cash flow more than the cost of running the UPS at the higher wages. That's the calculation that they just went through. All right, that's what Hollywood's got to figure out. Like this Hollywood strike that's going on right now, like movies will not get released. TV shows will not get produced. And so all these owners, these networks, these studios are going to see big revenue drops. Come September, there are no new TV shows. There is no new fall lineup on NBC, CBS, Fox. All those shows aren't being made. So you're going to be watching reruns. You're going to be watching reality TV and sports. That's it. And maybe that's what we're doing anyways. But even companies like Netflix, their shows aren't getting produced either. So that's the point. How much am I losing there versus how much do I have to pay incrementally to the actors? That's the calculation. If I can reinvest and pay them more and generate more, let's settle. If I don't think I can do it, keep fighting. That's what this fight is about. Why did RTX, formerly known as Raytheon's, why did their share price drop yesterday, $10 a share, when they announced their earnings, which were better than expected? Why did Raytheon see a big drop in their share price yesterday after announcing better than expected earnings?
Is it based on what they did with the money?
Partially. So there was big news in the defense and aerospace industry. And here is their stock price over the last 30 days. It was 3 days. That was yesterday. They announced before the bell, hey, we beat our earnings, and their share price went down by $10. Why? Anybody read the story about what happened at Raytheon?
Is it because of the recall,
What's the recall?
the jet engine recall with
Yep.
the metal contamination?
They basically said, exactly. They said, we have a subsidiary, Pratt & Whitney, which makes jet engines. And there's a manufacturing defect in our jet engines that we're now aware of. It affects 1,000 planes worldwide. So what we're going to do is we're going to pull out of service these planes and do emergency inspections and fix the ones that are defective. That's basically what they said. And it freaked out the market because the market's like, how much are you going to have to pay for this recall? Are you going to have to pay the airlines to basically take their planes out of service to fix and inspect them? And Raytheon said yes. And are you going to actually have to pay the cost of fixing these defective engines? And Raytheon said yes. And they said, basically, is this going to cause the FAA to shut down these airlines because of the defective engines? And Raytheon said, no, it's not a defect that will make short-term safety an issue, but it's something that we have to fix urgently. So then they said, how much is this going to cost? And the CEO of Raytheon said, in 2023, our free cash flow will be $500 million lower to account than we thought it was going to be to account for this recall. That is our current estimate. And when those words were uttered, the share price plummeted by $10. But that's the point. Less free cash flow for reasons that I just said, less value going forward. That's what the analysts have done. And by the way, 500 million is a swag, right? They don't know. They think it's going to be 500 million. The market, based on this drop in value, is worried that it could be worse. And Raytheon said, don't worry, all the planes that are flying can still fly tomorrow. The market is nervous that they may not come true, because when Boeing had these problems, like planes crashed out of the sky and they've had trouble delivering new planes for 3 years now. They have constant manufacturing problems. So I'm not saying that Raytheon, RTX now, rename themselves, is going to have those manufacturing problems, but that's the fear factor. And is 500 million the right number? Is it going to be bigger? But that's the whole point. Less free cash flow, less value, drop in share price. One-to-one relationship, no different than what we've been talking about in our analysis in this class.
Professor, can we see Airbus's chart? I think that the recall mainly impacted them.
The engines are in the A320neo. That's actually the plane that was most impacted by the recall. It doesn't affect the 737.
Right. Okay.
But yeah, Airbus, and you know who uses a lot of A320s in the US? Give you a hint, they start with a D.
Delta?
Why did Delta share price go down?
They won't be able to operate, or they won't be able to expand to, they won't be able to replace their fleet.
Because even if they don't have long-term consequences to their A320 engines, they're still going to have to pull them out of service, which means canceling flights. And for about a week, the planes are going to be sitting in a hangar being inspected, and they're not going to be flying. So Delta is going to have a revenue hit. And so the question is, how much is that does Raytheon have to make up? That's all being worked out right now. And there's no final answer, because we don't know how bad it is. They just admitted that there was a manufacturing defect, and it freaked everybody out. But the process of what's happening mechanically should be understood by all of you based on what we're doing in this class. Because this is the precursor to our next assignment, which is forecasting. We're going to take our concept of value historically that we understood, and we're now going to look at future value, because a company's worth its future cash flows. A company's not worth its historical cash flows. So that's where we're going next. All right, so here's what we're gonna do. I'm gonna give everybody a 10-minute break because these are long classes. And when we come back, you need this file. The file that you need is in here. Told you we're gonna go through lecture 3 very quickly, but what you're gonna need in week 3 is a file called right here, valuation model SBUCS start. So download and have open this Excel file. It is in the week 3 files folder. Okay, this is your homework assignment for next week. And here's a plus. We're going to complete next week's homework assignment before class ends tonight. If you're able to follow along with me and complete it in class today, you have completed your homework assignment for next week tonight. If you can't complete what we're about to do in class tonight, you have a week to do it. Okay, but you're going to need to use this file, and I'm going to give you a 10-minute break to get this file, and then we're going to come back on the other side at, what time is it? 7, 8 o'clock, 8:10. So we'll see everybody in 10 minutes. I'm going to pause the recording. Starting the recording again. As we are coming back, I have put into the chat a link to a video that was on CNBC yesterday, just talking about what's going on with this Raytheon issue. And again, there's more press. You can just do a Google search on it today about the airlines who are kind of upset about this because it kind of is hitting them at a terrible time this summer when they're already dealing with weather, where they're dealing with pilot shortages and other labor shortages. And now they're going to deal with this aircraft issue. So airlines are not happy at all. Neither are investors. But regardless, if you want to know more about it, there's a link to a video that talks more about the context. But the real context here is less free cash flow because Raytheon is going to take a free cash flow hit because they got to pay for this stuff and then expected, which is going to lower their valuation. And it's a direct link to what we've been talking about with CFI. All right, so class to date, we've kind of done 2 things. One, we talked about the concept of an EIC, which is basically saying we need to understand the external environment for a company, both today and over time, because half the company's performance is the industry that it's in. And it's going to be impacted by what's going on with the economy, and it's going to be impacted by industry issues, and it's going to be impacted by its competitive position in the marketplace. That's the E, the I, and the C. And so we need to understand that and how that's going to change over time for a company. Second thing we had to do is we said, even though the past doesn't guarantee the future, we do need to understand the past, kind of understand how companies are doing so that we can forecast the future. And in order to do that, to better understand them, we want to put things into an economic format tied to Modigliani-Miller. It benefits us into what we're about to do, but it also gives us better insight into how a company is generating cash in terms of the 4 buckets that we've talked about. And so that's where we have been so far. The next road on our journey, which is kind of like the 3rd section of the class, is forecasting. Again, company is worth the sum of its future cash flows. So how do we build that forecast of the future cash flows to figure out what we think they're worth today? Okay. And so that's where valuation models come in. So starting with lecture note 3, pull that one up. A little content, and then we're going to get into the mechanics of it with Excel. All right. So. When we do a forecasted valuation, we're going to kind of go through these 5 steps, right? So the first step, which we've kind of set up, is we look at the past, we analyze the historical performance to give us a baseline to forecast the future. Knowing that the past doesn't always repeat itself, but we still do need to have an understanding of the current situation and the historical situation to help us get a better understanding of what that future situation can be. So that's first step. Second step is that we need to forecast the company. And so we're going to forecast essentially 2 periods of time, right? Now, the difference between a project and a company is projects end and companies are assumed to last forever. So if I'm forecasting a company like Costco, you know, I'm how much cash are you going to generate over 50 years, not over just 3 years. So what we're going to do is we're going to forecast, we're going to call the short-term performance, which is year by year, we're going to forecast a company over time. Now, theoretically, we could say 50 years, forecast all 50 years. But the problem is, once you get past like 10 years of forecasting, God knows what's going to happen in the year 2035, right? So because it gets less and less meaningful to individually forecast years as we get further and further in the future, what we're going to do is we're going to kind of go year by year until we get to a point, and then we're going to proxy the long term using a concept known as continuing value. Okay. And so there's where the growing perpetuity equation kind of comes in, because that will be our long-term value period of a company. And then the 2 value periods are added up to become the overall value of the company. And one of the points the book makes is that it doesn't really matter how many years you forecast before you go into continuing value. Like, it shouldn't change the value of the firm, right? It just changes our understanding of the value of the firm. Okay. Meaning I could go 1 year of forecast and then put everything else in continuing value. I could go 10 years of individual forecast and then continuing value. Still get theoretically the same answer, right? Because there's one value of a company, law of one price, right? Regardless of how I am valuing it. That being said, we'll forecast the short term, we'll forecast the long term. The 2 values are added together. We'll then figure out a cost of capital to use to discount it to bring everything back to a present value. And then we'll go through the analytics. And that's kind of the process, pretty straightforward, that we are going to go through. And again, the forecast for a DCF is going to be matched to Modigliani Miller. So we're going to forecast all 4 of these buckets. We're going to forecast the operations, which is going to give us the operating cash flows. We're going to forecast the non-operating values to get the non-operating cash flows, add the 2 together to get us enterprise value. Theoretically, we could forecast out all the debt payments, but basically we'll pay off the debt. And then residual value goes to the shareholders divided by share price. Pretty straightforward process once we've put everything in this Modigliani Miller approach. Again, typical length of forecast is most models are typically 5 years before you go into continuing value, but it doesn't have to be. The actual answer for how many years you should forecast before you go to continuing value is, here's a rule of thumb. When we use the continuing value formula, which is the key value driver formula, which is basically a growing perpetuity, we're going to say that 3 or 4 values represent the entire firm. So the question is, how do we know that we have a good sense of what those 3 to 4 values are? Ideally, we'd like the company to be in more of a steady state when we go into continuing value. So another way to think about how many years do you really need to forecast to go to continuing value? When do I think the company is going to be more mature and in a steady state? Okay. So for example, if I'm forecasting a growth company that's still in growth mode, right? Even a Google is still considered growth mode. I might want to go more than 5 years out forecasting Google year by year, because in 5 years, Google's probably still not going to be mature. Amazon in 5 years may not still be mature. So I might forecast 10 years for Google or Amazon and then go to continuing value. Whereas if I did a company like Raytheon's pretty mature today, RTX, or even a company like Walmart. Like Walmart, Costco, I could probably go 3 years and do continuing value. That's probably not going to make too much of a difference because you saw how consistent Walmart and Raytheon was within a margin of error over time. Like they're pretty steady state. So I don't really need to go a lot of individual years before I kind of value a steady state firm versus a growth firm. They're not in steady state. So I would want to forecast until they got to more of a steady state. That is more ideal. But because people build these reusable models, they usually will just arbitrarily say, I'm going to forecast 5 years and then continuing value. I'm going to forecast 10 years, then continuing value. And probably 5 years is the most common one that's done out there for bigger companies. But nonetheless, what we're going to do is if you think about it conceptually, you can kind of do it 3 ways. When you do the short-term forecast, granularity can actually be helpful because you can be granular. You have more of an understanding of what's going on with the firm. So therefore, you forecast entire income statements and balance sheets. As you get to middle years, where it becomes a little bit more opaque, then you can kind of summarize things. So for example, I might want to forecast inventory. I might want to forecast receivables. I might want to forecast payables. I can do that for a few years. But after about 5 years, it's harder and harder to forecast those 3 items. So what I'm going to do is I'm just going to forecast working capital. I'm going to lump them all together and just forecast that one number as a forecast to each of those numbers individually. That's kind of that middle range. And then it's too hard to forecast working capital versus long-term capital after 10 years. So what I'm just going to do is I'm going to just forecast total capital. And then as a matter of fact, I'm going to summarize it and just do a perpetuity. And that's the long-term part of the forecast. So that's the whole point, is as you go longer out, we tend to go more simplistic in our forecast with the formulas. And when we're shorter term, we tend to be more granular. I'll pause. Make sense? Questions? So again, what we really want to do, and what we're going to do in this class, is we're going to arbitrarily do 5 years. Okay, just for simplicity. But what we really want to do is, as I said, ideally, most people do 2 time periods. They do year by year with a lot of detail, and then they do a continuing value, and they kind of skip that middle ground. Okay. And the whole point though is when you get to continuing value, which is going to be a big portion of the firm, ideally, you want the company to be in more of a steady state, mature setting. That's ideal. You don't always get there. The other piece you don't want to do is you don't want to be in a cyclical business and absolutely forecast this company that year 6, for example, is at the down part of a cycle. Because if you say that that is representative of your long term and the downward part of their cycle for an industry, then that might undervalue the firm. Same thing. If I'm a cyclical business like Caterpillar and year 6 is at the top of my peak of selling construction equipment, I don't want to say that is representative of my entire future of my business. I'd probably overstate the value of the firm. So that's the only other thing you got to watch out for is with cyclical businesses. You really want the continuing value to be at the midpoint of a cycle, not the top or the bottom, because you'll tend to over or undervalue the firms if you don't have them closer to the midpoint. So that's the only other tricky part when you value cyclical firms. So that's length and detail of forecast. In terms of the process itself, as I said, we start out with historical financials. For a startup, we may not have that. And then we have to figure out what the financials would look like when we're all grown up. So that's why we're not doing startups in this class. They're a little bit more tricky. But nonetheless, for a mature firm, start with the historical financials, understand the drivers, how they're built, get the sense of the business model. And then we build the forecast, starting with a revenue forecast and then a cost forecast. So we're going to forecast the revenue, we're going to forecast the income statement, and then we're going to forecast the balance sheet, and then essentially 2 parts of the ROIC. And then we're going to forecast the financing and calculate our ROICs and CFIs of the firm. If they have non-operating items, we might want to think about how to forecast those. And we also might want to start thinking about whether any of this is going to change. Fixed variable costs, will that change their margins if they get leverage over time? Does inflation play a role in this? We saw that to some degree with Walmart's numbers that we just looked at and Costco's numbers historically, which was putting pressure on their gross margins. How does that play out long term? So those are some other issues that we'll consider. But nonetheless, the ideal forecast ties the income statement driver, if you're forecasting for an income statement, in terms of the line item to the forecast driver of the cash flows. Okay. So for example, for operating items, we're going to forecast cost of goods sold, SG&A, and depreciation. And so the question is, what would drive cost of goods sold? What would drive SG&A? What would drive depreciation? Well, a driver of depreciation would be how much we spend on PP&E, because that's usually what we're depreciating. So we might think about forecasting PP&E to forecast depreciation as an example, right? And so that's the point. Like, what are the drivers that we're going to do that will forecast this? And typically, most of these are done as a percentage of whatever. And we want to tie, particularly when we do balance sheets, the balance sheet driver to the corresponding income statement driver. So for example, cost of goods sold comes from us selling our inventory. So therefore, inventory should be somewhat linked to cost of goods sold. So a typical forecast ratio would be inventory as a percentage of cost of goods sold. Accounts receivable are driven by revenue. I sell something, I wait to get paid. So accounts receivable is a percentage of revenue. Okay. Accounts payable usually come from not paying suppliers. Well, not paying suppliers associated usually for manufacturing firms with buying inventory. So I tie my accounts payable forecast to my forecast of cost of goods sold. That's ideal, right? So basically tie the income statement driver and the balance sheet drivers together to figure out what's the most reasonable way of forecasting, okay? What we're going to do this semester is simplify this and tie everything to revenue, okay? So basically, when revenue changes, how does inventory change? When revenue changes, how does accounts payable change? When revenue changes, how much does working capital change, right? How much does PP&E change? We're going to, for simplicity, tie it to revenue. But I want everybody to know that is a more simplistic view. If we really want to get granular, we would tie it to the actual driver. But nonetheless, that's part of what we're about to do. Okay. And so again, we will forecast an explicit forecast period, which they use the example of Home Depot in the book, which they will go year by year until we reach a point. Arbitrarily in our class, it could be 5 years. So starting in year 6, we'll get into continuing value. In the book, I think they did 9 years. But the point is an explicit period and then a continuing value period. And we add up the two values in today's value to get the value of the firm. The other thing to be aware of is what we do and use for continuing value. So this is just an argument for using the McKinsey key value driver equation as opposed to a straight perpetuity. Problem is when you use a straight perpetuity, cash flow over R, free cash flow over R, no plat over WACC, that what you basically do when you do a continuing value is it basically assumes that new investments actually earn your cost of capital. And so it essentially tends to move the value of the firm close to a zero spread over time. When you use a straight growing perpetuity, no plat over R minus G, cash flow over R minus G, it actually assumes exponential growth of your ROIC over time because you're going to grow at the growth rate. And so the point is using these two formulas, which is what most people use in valuation, has a distortion effect in the continuing value period. No plat or cash flow over discount rate, it's a straight perpetuity, tends to move the firm closer to its WACC. And it tends to overvalue firms that are growing. Growing perpetuities tend to overvalue firms because it assumes they never stabilize. They just continue to improve at the growth rate over time. So it tends to overvalue firms, right? So that's why McKinsey tried to come up with a compromise, which is the key value driver forecast, right? So their key value driver formula, which is cash flow times 1 minus G over ROIC divided by cash flow or WACC minus G, is basically the compromise that puts you somewhere in the middle. And they think it gives you a better formula. Just kind of graphically showing mathematically why we're using that. And then we got to be careful about some of the errors that we will make in valuation, which we'll talk about. But this is the formula that we are going to use for continuing value. Okay, and as I said, it's an improvement over these two because it's kind of a compromise that puts you in the middle, because it basically says that you are going to get a better return and it's going to grow, but it's going to grow at an incremental rate. So we have to still solve for what that incremental rate is. But as I said, it might be different than the rate that historically it was. That was the improvement in this formula that the book talks about. And then I guess the important part about terminology here is the formula, the ROIC in the formula is actually called a RONIC. And RONIC stands for return on new incremental capital. So translation, it's not your historical return on investment. It's the incremental return on investment going forward. And so that's what's key when we use the key value driver formula. So this shouldn't be your historical rate of return unless the past exactly repeats itself, right? Now, if I'm using a company like Costco, that might be okay, right? But if I'm using a company like Nike, what they're earning in 2023 may not be what they're earning in 2033. And so therefore, we might use a different RONIC for them on what is more reasonable for a long term. And so that's going to have an impact on what our value is. But nonetheless, figuring out the long-term return matters. All right. So you guys read the chapter. I don't think I'm going to cover that more much. I want to get the mechanical stuff, but any general questions about any of that before we get into the mechanics? All right, great. So during the break, you should have, as I said, downloaded the file that I gave you on Starbucks. So what we're going to do in class here, share this file. Is we're going to start with this template of the historical data, which is kind of like what you did last week, plus a couple of the additions that I gave you at the beginning of this class. And based on this historical data in the Modigliani-Miller format, we're going to create a enterprise DCF forecasted valuation model using Starbucks as our working example, right? And between now and the end of the class, in about an hour and a half, we are going to basically finish building an enterprise DCF of Starbucks, right? And to their actual share price today. And that is a process known as an as-is valuation model, meaning we build a model that values the current value of the company today, right? So we can kind of see what the cash flows are that lead to the current share price. That's your homework assignment for next week. All right. If I'm going to do this in class live, and I'm going to encourage you to do it exactly what I do. So that means that your homework assignment is to basically clone everything that I do so that we all have the same Starbucks valuation model for next week. Okay. And the reason why it's important that we all have the same model that we're going to all build together is because it's a reusable model that we can then put in any other company. And you will be doing that for future assignments, and you'll be doing that for your group case. So this is the model that we will use for the group case as well. But nonetheless, you have to build this individually or part of your, two-person study buddy groups, and then turn this in next week. But if you finish in class today and follow along with me, you're done, and you don't have to do any more work in the next week. So that's your bonus if you're able to follow along. All right, but this is being recorded. So if you need to see what's going on, because I'm going too fast, you can go back and look at the recording when we post it later tonight. All right, so what is this file? Let's just talk about this file. Has a series of tabs. They go from left to right. Okay. The first tab is the new tab that I mentioned today. It's got 6 years of raw historical Starbucks income statement and balance sheet data that was downloaded from Bloomberg. Okay, this is their last 6 historical annual reported years in raw format. Okay, The next tab, I'm going to jump over here, is called the income statement and balance sheet tab. That's what you were working on your last week homework assignment. So what I've done is created a standardized income statement and a standardized balance sheet. So we can take the raw data for just about any non-bank company, and it will then feed to create these standardized income statements and balance sheets, which you've already been working with. This model then takes your last assignment, takes these income statement and balance sheets and converts them. There's the converted TII, there's the converted TFI, and there's the full CFI. Now, you only did the free cash flow. The file that I'm handing you right now gives the entire CFI, and it balances. All these economic statements balance because those statements are standardized. So we have 5 years of historical economic statements coming out of the 6 years of historical financials. This is the auto-generated ROIC tree for Starbucks. So we'll auto-generate a tree. 2 other tabs that are new in this version of the file that are going to be relevant. Assumptions and ratios. So this tab, ratios, is just that. It takes 6 years worth of income statement and balance sheet data and puts them into a percentage of sales. So all of these ratios, with the exception of revenue growth rate, which is a percentage change, are a percentage of sales. Cost of revenue is a percentage of sales. Gross profit is a percentage of sales. EBITDA is a percentage of sales. Operating income is a percentage of sales. Inventory is a percentage of sales, etc. These are year by year percentage of sales historically of Starbucks historical data. Okay. So that's this ratio sheet. So here's the point. These statements create those ratios. Everything's a percentage of sales. This is best practice for forecasting and modeling. What we're going to do is we're going to forecast the ratios, and those forecasted ratios will create forecasted statements. So if we're going to forecast Starbucks, we need to know how much cash flow they generate in the future, which means we need to know their income statement and balance sheets in the future. Well, rather than forecasting the income statement and balance sheet line items individually, what we're going to do is we're going to forecast the ratios for the income statements and balance sheets, and those ratios will create the forecasted income statements and balance sheets. Another reason why we do ratio analysis, because it helps us think about what is a reasonable ratio to use in the future. Again, pausing, does that make sense? About the file, what we're about to do, questions about any of that? Okay. So then there's one other tab on here that's relevant, and that's called the assumptions tab. And you're going to see 3 numbers at this point on the assumptions tab, and they're all in fields that are yellow. So I'm going to give you another best practice when you build a forecast model. First, best practice. Do everything as a percentage, do as a ratio, forecast ratios. So that's the first best practice that we're going to apply in this class. Right? Best practice number 2, minimize in your valuation model the places that you're going to change company by company. Right? Because here's the point. If we're building a reusable model and we're doing Starbucks, and next week I give you Lululemon, and we put Lululemon's data in here, you don't want to have a hard-coded Excel assumption for a growth rate of Lululemon randomly stuck across 7 different tabs. Because when you reuse your model and your assumptions are scattered all over the place, you're either going to forget to change something, or you're going to not notice that something needs to be changed that's a carryover from Starbucks in your Lululemon data when you try to reuse the model. So a best practice when you build a model is to minimize the areas of your model that you're going to change, put them all in one place. And so in this model that we're going to build that's reusable, the things that change company by company are going to be on 2 tabs. assumptions, so our generalized assumptions are going to be in one place. So when we change assumptions for other companies, we know that all the assumptions are going to be changed in the assumptions tab to make it easier to reuse. And the reason why I use yellow, you can pick whatever color you want, but the reason I use yellow is I also want to know what I can change and what I can't change. Because when I change something, I don't want it to break a formula. I don't want it to break a reference. So if I'm building a reusable model that kind of like the income statement drives the TII, I don't want to go into the TII and overwrite a formula that breaks the TII so it doesn't auto-generate. So I got to know what I can change in my model and what I can't, right? Now, what I could do is I could start locking down cells that I can't change. But for purposes of this class, I'm just going to say yellow cells are changeable cells. If it's not in yellow after we build this model, you shouldn't change it. Okay, so the yellow cells are the changeable cells, and they're going to be in two tabs. They're going to be the ratios tab and the assumptions tab, and that's it. We're not going to change data anywhere else once we build the model. Everything else will auto-generate. That's better practice for building a valuation model. Does that make sense? Okay, so our goal, if we're going to forecast Starbucks share price, is we got to forecast Starbucks income statements and balance sheet. So we're going to start here on this ratios tab, and we're going to start forecasting Starbucks. So it is at this point that you should be doing what I do. So go to your ratios tab, go to cell H1, and write the word forecast. And the reason why I want to write the word forecast there is I want to delineate a lot of numbers, what's real and what's forecast. These are historical numbers, C through G. H going forward will be forecasted numbers. So that just helps me keep track of which. Now here's how we're going to do a forecast. My first year of forecast should be 2023. So this should say 2023 in cell H2. But I don't want to type in 2023 because if my historical years ever change, then 2023 is going to be hard coded and that's going to cause a problem. So what I'm going to do for cell H2 is do equals previous year plus 1. So it's a relative reference. It'll always add a year as the years change. My historical data changes. Now, the first number that we're going to change for Starbucks is we need a revenue growth rate forecast for Starbucks in 2023. So the way we're going to start off is we're going to put a placeholder that says 2023 revenue growth rate equals 2022 revenue growth rate. So cell H3 equals G3. And cell H3, because that's a number that might change, it'd be yellow. And that's alerting me that that's a cell that I might change because a revenue growth rate in 2023 might be different than 2022. Now, for purposes of building the model, just so we all have the same model, we're going to assume that 2022 repeats itself. Okay, but later we're going to change it to be more accurate. So we're going to start out by equals previous year and make it yellow. Now, you don't need to do this part yet, but I just want to show you how this will play out. So then we're going to go to the income tab. And for cell H2 equals previous year. So this part you can do, plus 1. That's our forecast, first forecast year. And then for cell H3 equals last year's revenue, so equals G3, times left paren 1 plus from the ratios tab, the growth rate in 2023, so cell H3, right paren. So here's the point. If Starbucks were to grow by another 11% in 2023, their revenue would grow to 37,790.1 billion. Or 35,790.1 billion. Now, since everything else is formatted to 1 decimal place, I'm gonna highlight down to here. Make that 1 decimal place just to be consistent. All right, so this is the part I don't want you to do. Let's say Starbucks revenue is 5%. 33,862.8. Let's say Starbucks revenue growth rate is 8%. 34,830.3. So what's about to happen is we will change ratios, which will build dollars in statements. That's the best practice for forecasting them up. Pausing. Questions? Make sense? But what you should have equals the previous year. Don't type in 11% because this is rounded. 35,790. Questions about that? You follow me on that? Okay. All right. So next, we're going to forecast cost of revenue, gross profit, operating expenses as a percentage of sales. Right now, what I'm going to do is I'm about to cheat. I'm letting you know that I'm cheating. All right. If I were doing this for a real company, or you were doing this for a real company, you would do this. You would say equals cost of revenue equals operating expenses, which are basically your SG&A expenses. And you'd make both of those yellow. And then you would take revenue growth rate minus this, and you would solve for your EBITDA. So equals this minus this, or sorry, revenue, which is 1 minus this minus that, and that would be your EBITDA. Okay, that's the way you would do it if you were actually building this model. But we're going to cheat. And here's what I mean by what we're going to cheat. The model doesn't care about cost of revenue and operating expenses. What the model really cares about is your forecast for your EBITDA. That's the cash flow. That's the cash flow from your income statement. That's the one that matters. So what we're going to do is we are going to forecast EBITDA directly equals the previous year. And we're not going to forecast those two individual items. For simplicity, to make things a little bit easier. So we're going to forecast revenue growth rate, and then we're going to forecast EBITDA directly. Now, again, EBITDA is based on the cost of goods sold and the SG&A, the operating expenses. But for simplicity, we're just going to directly forecast that. So that's one of the shortcuts we're going to take as we build our model. So forecast EBITDA equal the previous year. We're also going to have to forecast a rate of depreciation. And again, as a placeholder, equal the previous year. We'll make that yellow. But we're going to solve for operating income, also known as EBIT. What is EBIT? Equals EBITDA minus depreciation. H7 minus H8. That not going to be yellow because it's actually based on the two items above. Meaning EBITDA minus DA equals EBIT. So I don't want to forecast EBIT separately if I'm forecasting EBITDA. And so that's a choice that we're making in the model. Meaning we could forecast EBIT and back into an EBITDA by adding in the depreciation. In this case, we're going to forecast EBITDA and back into an EBIT by subtracting depreciation. So for these three numbers, pick two, solve for the third. These are the two we're going to forecast. This is the one we're going to solve for. Next, tax rate. What do we think Starbucks is going to pay in taxes next year? That's yellow because that could change. What is our NOPAT or NOPLAT as a percentage of sales? Well, here's the formula, by the way, which you could just copy over one cell from G11 to H11. But basically what we would do is we would take our operating income and we multiply by 1 minus the tax rate. And that would be our NOPLAT percent. Change that back to a percent. The yellow. I'm sorry, that's not yellow. Take it back because that's being solved for. Fill in that one. And then finally, non-operating gains and losses, which drive a non-operating cash flow. As a placeholder equal to previous year, that cell is yellow. Because that could change. So those become the key income statement items that we are going to forecast as a percentage of sales. Now, I'm going to take column H. I'm going to copy the whole column. I'm going to go over here to column M. And I'm going to paste. So I'm going to take what I just did in column H and paste it out so that column M is forecasting 2028. So we're just repeating 2022 6 times at this point, all equaling the previous year. So we now have ratios forecasted as placeholders through 2028. And I would suggest saving this file. Because it would be a tragedy if you start building this and then you lose your work halfway through. All right, did everybody get to this point? Questions about getting to this point? Straightforward, easy. All right.
Can you
so
show the no plat formula once more, please?
simple way to do this is cell G11 has the formula. You just copy it over.
Okay.
But to H and then over. But the whole idea is you take your operating income and you take out the taxes. So H9 times 1 minus the tax rate. So no plat or no pad is percentage of sales. It's what's left after tax. So just take it out. That's that formula. Any other questions? All right, now what we're going to do is we're going to go to the income statement and we're going to build out the income statements in dollars based on those ratios. So again, the number we're keying on is we're going to start right there. EBITDA. We're simplifying because rather than being granular about these other items above it, we're going to lead to just forecasting EBITDA directly, make our lives a little bit simple. So EBITDA in 2023 equals from the ratios. EBITDA as a percentage of sales in 2023 is cell H7. And we're going to multiply that by, from the income tab, 2023 revenue. Revenue times the percentage of sales says our EBITDA would be 6821.9 if we get 19.1% of sales. Same process for depreciation. Equals the ratio. Depreciation as a percentage of sales in 2023, 4.7, so H8. Times from the income tab, revenue, 35,790, H3. That'll be 1697.3. That's depreciation as a percentage of sales. And I think I put it in the wrong. It's all too high. So there's our forecast for EBITDA and depreciation. So operating income, solve. You see the formulas over here. Equals, take our EBITDA minus our DA, H8 minus H9. Gives us EBIT or operating income of 5124.7. So very quickly, we have a forecast for Starbucks revenue, EBITDA, and operating income for 2023, assuming those ratios come true. So we got these numbers? Okay, now we're going to forecast the rest of the income statement. The next line item that we forecast is interest expense. Okay. Now, here's the thing. Interest expense doesn't affect free cash flow. So to be honest with you, what we put in for interest won't affect the valuation. But that being said, we want to have a realistic income statement. Point number two, we use a constant WACC across the valuation. And the reason why we use a constant WACC is we assume a target capital structure which stays constant. Right? So if the capital structure stays constant, the amount of debt and equity you have stays constant, then your WACC stays constant. That's the typical way we handle evaluation. So we basically come up with a target capital structure and use the WACC based on a target capital structure. Now, one more simplifying step we're going to use in this class, which most people use in the real world, is we're going to say the current capital structure equals the target capital structure, which is another way of saying the current WACC continues. So I don't have to redo the WACC. Okay. Now, if a company's going to change its capital structure, we would want to adjust the WACC based on the new target capital structure. But for most companies, they tend to leave the debt and the equity alone within reason. So therefore, constant WACC. Constant WACC, constant debt, constant interest. So as a simplifying starting assumption, whatever interest they have, they keep, equals the previous year, because they're going to keep paying it because of the same amount of debt. We're not going to change the debt. Same thing with interest income. They're earning interest income off of excess cash. If we're not changing the excess cash all that much, interest income shouldn't change. So interest income equals the previous year. Now, in the case of Starbucks, it's 0, but nonetheless, if a company did have one, it would be equaling the previous year. So for cell H10 equals H11, sorry, equals G11, and for H12 equals G12. Foreign exchange gains and losses. I don't know what's going to happen to the dollar, neither do you, in the next several years. So it's too hard to forecast foreign exchange gains and losses. So for the future, we're not. We're just going to put 0. Because I don't know whether or not the company's going to gain or lose. And most companies tend to hedge anyways, so they mitigate their gains and losses against currency. So as a placeholder, we're going to put in 0 for foreign exchange gains and losses. I saw a hand there. So Fargo?
So you would, yeah, you do that even if you had a company that had foreign exchange losses in a previous year?
I would still put it as 0 as a forecast. Now, here's the point. 2 reasons why. Number one, what you're going to quickly realize is it doesn't affect the valuation. Okay. And number two, you can always override these assumptions. So let's say you're doing Coca-Cola, which has a lot of international operations, and you're like, okay, they're pretty much going to consistently have foreign exchange gains or losses. I could forecast those. Okay. But I'm telling you, in terms of the impact of the valuation, it's usually pretty minimal for most companies. And so therefore, as a placeholder, we're going to start with 0. But anything that I put in here, you're always welcome to override. All right. But this is going to be the 95-5 rule. For 5% of the companies, you might want to override, but for 95, you're not. So I'm going to try and keep it simple for our reusable models. Okay. Which leads to the next assumption. Same thing, income loss from affiliates. If I own passive, these are the equity investments in other companies, gains or losses, I'm going to say those gains or losses are consistent. Okay. Again, as a simplifying assumption, equal previous year, but we can always try and forecast it for non-operating purposes. And non-operating gains or losses equals the ratios, non-operating gains and losses as a percentage of sales. So we'll forecast it here, H12 times income revenue, H3. So again, we'll change the ratio for non-operating gains and losses to proxy most of the non-operating gains and losses. Now, if we take operating income minus interest expense plus interest income minus foreign exchange losses minus income loss from affiliates minus non-operating gains and losses, we get pre-tax income. So that's what we need to solve for here for pre-tax income in this cell. To make your life a little bit easier, I've already put that formula in 2022. So simple way to do this, take 2022, copy G16, go to H16, paste that formula. So 4749.4 of forecast pre-tax income for Starbucks in 2023. Everybody get to this point? Questions about any of that? The next line item is how much tax? Yep. Out of T2? Out of T2?
Could you please go back to cell H15?
Sure. That's because on the ratios tab, the last income statement ratio was non-operating gains and losses as a percentage of sales. That's ratios H12. We're going to take that ratio and multiply it by 2023 revenue, income H3.
Thank you.
Sure. All right. Next, that gets us to our pre-tax income. Now we had to pay taxes on the pre-tax income. So equals for the ratios, the tax rate that we're forecasting right now is in H10. That's our 2023 tax rate, multiplied by income H16, our pre-tax income. So that income times that tax rate says we'll pay $1,064.5 in taxes if we make 47.49 in pre-tax income. So the income after they pay those taxes equals pre-tax income minus the taxes, or 3684.9. So we have quickly forecasted Starbucks income before extraordinary items to be $3,684.9 million if those ratios come true. Now, our next item to forecast is an extraordinary gain or loss. These are one-time things that people didn't expect to happen that are non-recurring. So the definition of extraordinary is shouldn't happen again. By definition, it's extraordinary. So for 2023, 0. Like an extraordinary loss in 2022 shouldn't repeat. If extraordinary items repeat, they're not extraordinary items, they're operating items. So by definition, we shouldn't have extraordinary items in the future, 0. Now, let's say a company announces a layoff. All right, Starbucks is going to lay off 5,000 workers. All right, and we know that they're going to do this next year. Okay, I might put in an extraordinary item for 2023, but I'm not going to repeat it in 2024. Okay, so generally extraordinary items don't repeat, so 0. We don't forecast extraordinary items. So our net income before minority interest equals the income before extraordinary items minus the extraordinary items, which right now are 0. So they'll be the same, 33.6849 billion. Now, next, minority interest payments to the minority shareholders. Starbucks last year paid 1.8 million to the minority shareholders. So equals last year's payments. We're going to keep paying whatever we were paying in the future. We're not going to change the payments to the minority shareholders. So our net income is going to be the total income after the extraordinary items minus, so basically equals this cell, which is H20 minus H21. Equals H20, H21. $3,683.1 million after we pay out that dividend. That is our bottom line net income. So again, very quickly, we have forecasted a 2023 income for Starbucks after tax. Now, the next items are not technically on the income statement, and they're not part of TII, but they're going to be very important when we forecast a balance sheet and figuring out retained earnings. So the next item is how many dividends are we paying to our preferred shareholders? Right now, Starbucks does not have preferred stock, so it doesn't pay preferred dividends. But if another company did, just like interest expense, since we're leaving the capital structure alone, whatever dividends they pay, they keep paying. So whatever dividends in 2023 they pay equals the previous year. Other adjustments to equity. Other adjustments to equity are basically when FASB changes GAAP, or International Financial Statement Rules are changed by the IFRS, or get changed, a GAAP gets changed. Then we make accounting changes to our statements. We restate items, we change items. Those are the other adjustments. Typically, these are non-cash items, and they tend to be one time. And to be honest with you, I don't know what FASB is going to do with GAAP in a couple of years. Neither do you. Neither does FASB. So generally, we don't forecast other adjustments in the future. Again, if you know something's going to change, you're always welcome to do it, but it's not going to affect the valuation. It's just paper moving around. So for simplicity, what I want you to do, make your life easy, take cell here, H, whatever that is, H or G 25, copy it and paste it in H25. So 4,231.9 million net income available to the common shareholders after the preferred shareholders have been paid and after the other adjustments to equity. Then we have the dividends to the common shareholders. Because we're not changing the capital structure, equals the previous year. They paid 2.2 billion in dividends last year. They're going to pay 2.2 billion in dividends this year. Net income minus dividends is the change in retained earnings. Your retained earnings is what you don't pay out to shareholders. Net income minus dividends is change in retained earnings. So that's the formula for cell H27. David?
Wouldn't we expect their dividends to keep increasing or no?
The answer is potentially, because they've been doing it historically. You can see it right here on the screen. However, we're not going to forecast it, not yet. Right now, we're just repeating 2023. Later, we'll talk about how we change the forecast assumptions. But as we're building the model, we're just going to leave it steady state. Okay.
I'm sorry, I'm not tracking the net income available to common shareholders. What did you do there?
I just took this cell, which is G25, which has the formula in it, which is basically this minus this minus this. Take this cell, copy it, paste it there.
I think somehow I got a different number too, and maybe I messed up.
Yeah, so I don't see how those numbers add up. Why wouldn't?
Your number's hard coded for some reason.
Do me a favor, take cell G25, copy it, paste it into H25. I'm going to come back to this. Then take H26 equals G26. This is the dividends. This minus dividends equals that. Okay. However, and this is actually the point I was trying to get to, which is part of your confusion. Data source. For whatever reason, the Bloomberg data source that gives us data reports dividends as a negative number. For whatever reason, the Bloomberg data source gives us cost data, depreciation, as a positive number. Okay, they both are to some degree expenses, right? But here, depreciation or operating expenses or interest expense, those are positive numbers, but dividends are negative numbers. They both reduce your cash flow. So that's just being sensitive to your data source. So because I know my data source is going to give me dividends as a negative number, and because I know that net income minus dividends equals change in retained earnings, the formula for change in retained earnings equals net income plus H26, H25 plus H26, because I know that H26 is coming in as a negative number. Because if I subtract it, the double negative will have the impact of adding it.
Well, what my confusion is that in the net income available to common shareholders, I'm getting 3683.1, not 4231.9.
Yeah, you should. You should, because I accidentally typed something there. When you copy it over, you should get the same number. You're right.
Okay, thank you.
1419.8. Thank you. Yeah, I was like loose fingered copy on mine. But the concept here is the double negative. Everybody sees that. That's why I did the plus the negative as opposed to subtracting. So it's really this minus this equals that. This minus this equals that. But because this is coming in as a negative number, it's this plus the negative number equals that. The reason why I had you copy this formula over is the same thing happens with cash preferred dividends. Even though Starbucks does not pay preferred dividends, if another company did, this would be a negative number. So the formula that I had you copy over is net income plus the cash preferred dividends, not minus it, because it's going to be a negative number, then minus the other adjustments. That's the formula that I had you copy over. And I'm only doing it this way because I know that Bloomberg will give me this number, the dividends for preferred shareholders and the dividends for common shareholders as negative numbers. And that's just another best practice. You have to know your data source. Like, let's say you went to a different data source for your model, or you typed it in manually. Like if you typed in a positive dividend, or you basically had another data source that gave you dividend as a positive number, then that would actually screw this up. So generally, if you build reusable models in the real world that are tied to data sources, you have to be aware of the unique things that that data source does. Because if you ever go to another data source, it may not do it in a consistent way across companies. And that's where people can often make mistakes. So we are building a model that's actually tied to Bloomberg. Because I know how this data comes. And because it's used by real companies in the real world, it will always come in this format. Okay. But if you use a different data source than Bloomberg, you got to be careful because our model is assuming data comes in a certain way, positive or negative. All right. Did everybody get to this number? 1419.8. Take column H, copy it, go over to column M, select and paste it. And you now have forecasted income statements for Starbucks going through 2028. Go to your TII. Take column G, which is the 2022 TII. Copy it. Select over to column M. Paste it. You now have forecasted and balancing TIIs going through 2028 for Starbucks. The only difference is starting in 2023. This is no longer history. This is now part of the forecast. Forecast, right? So I now have 6 forecasted income statements and 6 forecasted TIIs for Starbucks, assuming these ratios come true. And I'm going to save this because I don't want it to crash. All right, questions?
Professor,
These numbers.
for H8 and H9, could you show what's in those again?
In which tab? The income tab?
The income tab, yeah. I don't
Sure.
have.
In H8 and H9, H8 is EBITDA. So it's going to be, and similar in H9, it's going to be ratios H7, which is EBITDA as a percentage of sales, times income H3, which is the 2023 revenue. And then depreciation is going to be ratios H8, which is depreciation as a percentage of sales in 2023, times income H3, which is $2023 of revenue. The ratio times the dollar gives me the dollar.
Thank you.
And that's a consistent approach. But as I said, in about 20 minutes, 30 minutes, we've just created forecasts for Starbucks for the next 6 years. Yes. David?
Did we not need to do gross profit, other operating revenue?
So that's what I said. So the answer is yes and no, meaning ideally you do this as well. Okay. But for simplicity, the reason you do this is to create this. So if I'm actually talking to Starbucks, they're gonna want to know what their cost of goods sold is versus what their overhead SG&A ratios, operating expense ratio is. Okay, that's gonna be important. That's part of the tree, right? But to be honest with you, think back to the tree. What we care about in the tree is this number. Like, yes, this is the click down of how we got to this number, but this is the number that drives ROIC. Yes, these three lead to that, but if I forecast that, I don't need these three. So we're simplifying. But to be honest with you, I'd probably want to go here if I were really doing this, but I'm trying to keep a couple things a little easier for you this semester. And practically, the model doesn't care because this is what's going to drive the cash flow.
Whew.
Other questions? All right.
Should we put it in just so we have it in our models if we were ever to add it in the future?
Your choice. I'm not going to require it. The model I'm going to give you doesn't have it, but you're welcome to do it. But here's the point. They have to sync. This and this lead to that. So if you forecast these two, they have to equal that. 1 minus these two equals that. So then just like operating income, if you're forecasting these two, this you're not forecasting anymore, you're solving for. So you have to change that. Okay, so that's the point. It's because this is based on those two. So they have to sync. So you can't forecast them independently.
Got it. Thanks.
All right, let's go do a balance sheet. Down here are 11 balance sheet ratios, all the way through other long-term liabilities as a percentage of sales. This is the other reason why we are differing from the book and forecasting everything to revenue. You're going to see the benefit here in just a second, right? So what we're going to do is we're going to start with 2023 accounts and notes receivables or percentage of sales equals the previous year. So H14 equals G14. That is something that can change. Yellow. Then we're going to take cell H14 and we're going to copy it. We're going to select all the way down to M23 and we're going to paste it. So basically what that says is all of the ratios year by year for the balance sheet as a percentage of sales repeat themselves based on what happened in 2022 for 6 consecutive years. So it just equals the previous year repeated. So we now have forecasts for ratios for the next 6 years. Okay. The only one we didn't forecast is this bottom line invested capital to sales ratio. This ratio is this ratio on the tree. For now, we're not going to forecast it. We're going to solve for that. So take cell G24, copy it, go to H through M24, select it and paste. That's a formula. Okay. Now, right now it's 0 because it's basically invested capital to sales and we don't have a balance sheet. So therefore invested capital is 0 for Starbucks right now. But when we do build a balance sheet, that number will fill out. And that will be a forecast of that. Okay. So we're going to forecast the balance sheet to forecast that. Okay. So that's just that. So back to balance sheet. So then what we're going to do is starting out here, make it a little bit bigger. Where's on this page? Okay. Is starting with cell H1. This is our forecast. And our first year forecast is previous year +1, relative reference 2023. And then we're going to forecast the balance sheet items. Now, these are the balance sheet items that are all a percentage of sales. The first one being accounts and notes receivable for 2023, which is cell H14. So here's how it works. For accounts and notes receivable, in 2023 in dollars equals, so that's cell H6 equals from the ratios tab, 2023 is column H, accounts receivables percentage of ratio H14, that cell times from the income tab, 2023 revenue, which is H3. 1,304.5 million of accounts and notes receivable if we hit 3.6% of revenue in 2023. Now, again, I'm going to take all these numbers and just format to one decimal place just to be consistent with what I see before. The next ratio is unbilled revenue. So same concept. We're going to repeat this 9 more times. So equals the ratio, unbilled revenue, it's percentage of sales. They don't have any, but another company might, H15, times income, H3, 2023 revenue, 0. The next item is inventories. So equals for inventories, which is H8. We're going to go to the ratios tab. Inventory as a percentage of sales is H16 times income. H3 is revenue. So that would be 2,415 million of inventory. Other current assets equals ratios. That's row 17. So H17 off of ratios times income I3, which is 2023 revenue forecast, 536.8 million of other current assets. The next ratio is long-term investments equals ratios. Long-term investments is row 18. So H18 off the ratios times income H3, which is 2023 revenue, 309.7 million of long-term investments. The next item is net fixed assets equals on the ratios. Net fixed assets are 45.2%, which is row 19, H19 times income I3, 2023 revenue. That means 16,176 million of stores. The next item we're forecasting is other long-term assets, which is row 14. Equals as a ratio. Other long-term assets as a percentage of sales, which is H20 times income H3, 2023 revenue, gets us 2,957.6 million of other long-term assets. Now we're going to forecast accounts payable. Equals from the ratios. Accounts payable as a percentage of sales, 13.4%. So that's H21 times income H3. So 4,793 of accounts payable. The next ratio is other short-term liabilities equals ratios H22 times income H3. And then we have our other long-term liabilities is the last ratio. So equals ratios H23 times income H3, 7646.5 of other long-term liabilities. So those are all the ratios on the balance sheet that I am choosing to forecast as a percentage of sales. And you might say, why do you do those? Because these are generally the operating balance sheet ratios. So what I've done is I've identified mostly the operating ratios of the balance sheet, and those are the ones that we're going to forecast directly. But when we go back to the balance sheet, as percentage of sales, we still got to finish up the entire balance sheet. So what I'm going to show you is how to get a balancing balance sheet automatically without a circular reference based on your ratios forecast. You cannot have a circular reference in your model. Any Excel model that has a circular reference in it, you should always be suspicious of it because it's an invalid model. In this class, if you turn in an invalid model with a circular reference, I'm not grading it. So can't have them. So how do we do that? How do we avoid that? We're going to finish forecasting liabilities and equity first. So let's start with equity. We got to forecast total preferred equity for the firm. Because we're leaving the capital structure alone, whatever preferred shares they have outstanding, they keep. So for 2023, H28 equals G28. For minority interest, whatever minority stakes they have in other companies that they've consolidated that they have to pay out to those minority shareholders, we're going to leave that alone. We're not going to change our minority shareholders. Equals the previous year. Whatever share capital and paid in capital, we're going to leave alone. We're not going to issue any new stock. We're not going to buy back stock. Whatever share capital you have, you keep. Equals the previous year. And APIC stands for additional paid in capital. The final one is retained earnings. That one we have to solve for. The formula for retained earnings in H31 says take last year's retained earning balance, which is negative, and then add to that from the income tab, which is why we did this, H, which is the current year, change in retained earnings, which is H27 off the income tab. So the reason why we did net income minus dividends is that's how much retained earnings should change. Should go, in this case, go up by 1419.8. So on our balance sheet, what we're going to do is we're going to take last year's net income and add the change in retained earnings. So basically it goes up by 1419.8. When we sum these four categories, preferred equity, minority shareholder interest, share capital, and retained earnings, that gets us a forecast for total equity of the firm. In this case, it's negative 78.9. There's our forecast for shareholder equity for Starbucks in 2023. Questions about any of that? All right. So, Kathy, did you have a question?
Cell H32, H31,
All right, which number are you asking about?
H31.
H31.
Retained earnings.
So last year's retained earnings, G31, plus this year's change in retained earnings, which was income H27, was the very bottom line we solved for on the income forecast. So it's, because remember, a balance sheet, an income statement explains the difference between two balance sheets. So that's the point. Starting balance sheet plus change in retained earnings equals ending balance sheet equals ending retained earnings. That's the formula that we're using here.
Okay, thank you.
All right, now we got to forecast the liabilities. What we didn't forecast as a percentage of sales, interest-bearing debt. That's short-term borrowings. Because we're leaving the capital structure alone, we're leaving the short-term debt alone. So whatever debt they have, they keep. Equals the previous year. We're not changing the debt because we didn't change the interest expense. Same thing, long-term borrowings, that's long-term interest-bearing debt. Equals the previous year. We're leaving the long-term debt unchanged. We're not going to change the debt. Pension liabilities, same thing. If they have a pension liability, they're still going to have a pension liability equal the previous year. Now, according to US accounting, companies are not allowed in the SEC to grow their pension liabilities over time anymore. It's now against the law. Can't do it. Can't have unfunded pensions in the future. So basically, whatever pension you have, you know, Starbucks doesn't have a pension, and it's not going to grow. So equal the previous year. So we've now forecasted all of the interest-bearing liabilities of a company. So all that's left is to solve. Total current liabilities is the sum of the three above, the accounts payable, the short-term borrowings, and the other short-term liabilities, equals the sum of those three. 9808.4. Long-term liabilities is the sum of the three above, the long-term borrowings, the other long-term liabilities, and the pension liabilities. 28,281.6. Total liabilities equals the current liabilities, 9808, plus the long-term liabilities, 28,281, or 38,090. Total liabilities and equity equals the 38,090 of total liabilities, plus the negative 7278.9 of equity, 3811.1 of liabilities and equity summed up. So we now have a forecast for the liabilities and equity side of Starbucks. It is very important that a balance sheet balance. So here's the trick to making sure that our forecasted balance sheet is going to balance. Go to cell H16, which is total assets, equals H33. Voila, your balance sheet will always balance. Assets will always equal liabilities and equity. Now you might say, how do we actually get all of this to add up to that? And the answer is, one of these items is going to be what we call a plug, which means we're going to solve for one of those items to make sure that all of those add to that number. The plug is excess cash. Okay, that's going to be the number that changes to make sure our balance sheet balances. So in order to plug excess cash, we have to solve for the other asset categories. What's left that we have to forecast? Number one, operating cash. We need a forecast for Starbucks operating cash for 2023. Here's where it's going to come from. Equals. So H4 equals, from the assumptions tab, there's a forecast for B3 operating cash as a percentage of revenue. It's 2%. That's the assumption we're going to start with. It's the one I mentioned in class last week. 2% of sales is 1 week of cash. Right? So 2% of revenue, assumptions B3, times income H23. So 2% of H23 is 715.8 million of operating cash. All right. And you might say, gee, why did he use the assumptions tab for operating cash? Why is operating cash not on ratios? And that would have been a good question. And this would be the answer. The reason why it's in the assumptions tab is ratios tend to change year by year. For example, EBITDA 21, 20.9, 13, 22. They change year by year. Operating cash doesn't change year by year. You will always need 2%. So assumptions are things that kind of are universal across all the years. Ratios are things that can change year by year. And since the operating cash doesn't usually change year by year, I put it here on the assumptions tab. That's why it's there. Right? But it has an implication to our model. When I copy and paste this number, 715.8, this formula, I have to also edit the cell, and in front of the B, put a $sign, and in front of the 3, put a $sign. So $B, $3. And the reason I'm doing that is because that tells Excel that this is an absolute reference to cell B3. So when I copy and paste, it will always use cell B3 in the formula. Otherwise, it'll use C3, D3, E3, etc. as I copy and paste, because there's only one operating cash. So I'm going to make that an absolute reference. The final item that I have to forecast to then plug is goodwill. So here's the point about goodwill. Theoretically, you don't amortize goodwill anymore. You only impair it, which means it could be on your balance sheet forever, unless it's impaired. Secondly, goodwill is going to be created when we do acquisitions. Well, we don't know who Starbucks is going to buy in the future. And we don't know how much they're going to pay for them. We don't know how much goodwill is going to be created by them. As a matter of fact, most acquisitions are NPV 0 to begin with. So even when companies do acquisitions, they don't usually create a lot of value from acquisitions. That's what the academic data says. So for purposes of our model, we're just going to leave goodwill alone. We're not going to assume they do any more acquisitions. And if they did, they'd be NPV 0. And we're not going to assume that we care about the impairments, because even if they impair the goodwill, it doesn't affect cash flow. So equals the previous year for goodwill. 3490, 39.4. So now we're ready to solve for excess cash. Here's how you plug for excess cash. Excess cash, which is cell H5, equals total assets minus everything else, minus operating cash, minus accounts and notes receivable, H6, minus unbilled revenue, H7, minus inventory, H8, minus other current assets, H9, minus long-term investments, H11, minus net fixed assets, H12, minus goodwill, which is H13, and minus other long-term assets, which is H14. When I hit enter, I should get 2955.7 of solved for excess cash and no circular reference. Questions about that? All right, so for total current assets, sum everything above. H4 all the way down to H9. That's our current assets. Long-term assets, sum from H11 through H14. That's our long-term assets. And by the way, if I want to do a check, equals current assets, which is here, plus long-term assets, my balance sheet balances with the plug. So the sum of all the items equals the total that I plugged. So you should get assets that now equal the liabilities plus equity. And so here's the final step. Take column H, select it, whole column, copy it, go to column M, select it and paste it. And we now have forecasted balancing balance sheets going through 2028. Questions about any of that? And were you able to get to that point? So that your 2028 assets should be 55,416.3. Adam?
For some reason, my M16 is like $15 off. Do you know what that would be from?
Are you dragging and dropping?
I copied and
Are you copying and pasting? Or are you dragging by clicking on that anchor and pulling it across?
dragging it. Yeah, I'm dragging it.
Unfortunately, what might be happening is I discourage dragging, because what Excel will do, and it won't tell you, is it might create a series. And it thinks, oh, you're dragging, you want a series. They'll start adding 1 to every number after it. And it's just arbitrarily gets bigger without you knowing it. So a 0 starts going up 1, 2, 3, 4, 5, 6, 7, 8, 9. So that could be happening in your model. So look to see if you have an item that looks like that. And then just copy and paste over that as where you anchored and dragged. That's one of the biggest sources of that. The other one is if you just, I don't know, made a mistake along the way. But nonetheless, you should get this number. You should match these exactly. Any other questions?
Professor, could you show us how you got cell H10?
Sure. H10 is the total current assets So the idea here is what we're going to do is we're just going to sum. We're going to sum H4 to H9. Just add those up. Because everything above it is a current asset. So we're just adding them all up. Same thing with the long-term assets, H15, adding up H11, 12, 13, and 14. Those are the long-term assets. All right, home stretch. So we are now going to go to our TFI. We're going to take column G. We're going to copy it. We're going to go to column M. We're going to paste it. We now have 6 years of forecasted balancing TFIs. These are now forecasts going through 2028. Because we have the forecasted balance sheets. These are now the forecasted rearranged TFIs. Because we have TFIs through 2028 and TIIs through 2028, we go to the CFI tab. We can take column G, select it, go to column M, paste it. We should now have 6 years of forecasted CFI for Starbucks, including free cash flow, through 2028. So again, this is my forecast year. But that's the key. Now that we forecasted the granular income statements and balance sheets, we now have forecasted TFIs, TIIs, which means we have forecasted CFIs, which is what we were leading up to. So I now have a cash flow forecast for Starbucks going through 2028. And I should get a free cash flow of 4277 in 2028, if you're following along. And copy. All right. Our ratios created these forecasted statements and forecasted cash flows. The final model tab, which you have to add over here by clicking plus to add a worksheet. And I usually put at the end, just drag it over here, called sheet 1. This tab we're going to rename DCF valuation. This is where we're going to do the enterprise discounted cash flow valuation of Starbucks. So we're going to take those cash flows and turn it into a share price forecast. Okay, so here is how we're going to do that. On this new tab, new worksheet in the model at the end called DCF valuation. Okay, operating cash flows. What are our operating cash flows? Those are our free cash flows. What is our forecast for free cash flow? Okay, well, we actually have a forecasted free cash flow in our valuation model. It's on the CFI tab. On the CFI tab, we have a forecast, year by year forecast of free cash flow from 2023 through 2028. Okay, 6 years of forecasted free cash flow right here. That's what we're leading up to. I want to take the first 5 years, and that's my year by year forecast period. Year 6, continuing value. So the first 5 years of free cash flow are my year by year forecasts. So what I'm going to do, starting with 2023, I go down the rows as opposed to across the columns. My first year is 2023, a forecast. My 2023 free cash flow, cell B2 on my new tab, is off of CFI. 2023 free cash flow is H14 off the CFI, 2541. That is my forecast to one decimal place of free cash flow. I have 5 more years equals previous year plus 1. And I'm going to forecast through 2027. So in 2024, my forecast for free cash flow is I-14 off the CFI. Yeah, just format this to decimal place. In 2025, my forecasted free cash flow off the CFI is J 14. 2026 off the CFI, it is K 14, and 2027 off the CFI, it is L 14. Those are the next 5 years of free cash flows for Starbucks, assuming my ratios come true. So that the total operating value first 5 years is the sum of those free cash flows. That's how much cash flow we're generating in the next 5 years. 15,817,000,000 operating cash flow. Right now, problem with that is it's not present valued. Yeah, it's just a nominal value. And if we're going to do a DCF, we need to present value these cash flows. So our next step is to make sure that we turn this into a present value. So what I need to do is I need to discount, use a discount factor, these cash flows. So I get a discounted free cash flow. I get a present value of these free cash flows, right? So what is a discount factor? Well, present value formula says take the cash flow divided by 1 plus R to the number of periods. So in our case, 1 divided by 1 plus R is the discount factor. That's how much we're going to present value something with. The question is, what's the R? What's the rate of return? Well, 1 divided by 1 plus assumptions, it's our WACC. Cell B4 off the assumptions tab is the discount factor. That's the R. So 1 divided by 1 plus assumptions B4 is the same as multiplying by 0.9259. So take our cash flow at the end of 2023, multiply by the discount factor, and the present value, 2352.7. That's the discounted cash flow. All right, now I want to present value all of these as well, which means I'm going to copy this down. So I'm going to make this a $B, $4. So it always refers to the WACC on cell B4 of assumptions. I'm going to copy and paste this for the 5 years. Except the difference is in the second year, the formula is 1 plus R squared. So shift 6, 2. In the third year, it's 1 divided by 1 plus R to the third power. So shift 6, 3. In the fourth year, it's 1 divided by 1 plus R to the fourth power, shift 6, 4. And in the fifth year, it's 1 divided by 1 plus R, 1 divided by 1 plus R to the fifth power, so shift 6, 5. And so same concept, take the cash flow times the discount factor. If you want, you just copy this down, but those are the present values. And this would be the total value in today's dollars at that hurdle rate, 12,430,100,000. That's the operating value that contributes to the share price for selling coffee for the next 5 years. Questions about any of that?
Quick question, Professor. Why, I mean, I guess this is lays out nicely how we get from one to the other. Could we also use a formula?
You could use the present value formula in Excel and get the same.
Okay. Is there a reason to do it this way?
No, just I do it this way because I went to school and we used to use calculators and did this in the 80s. It's the way I've always done it. But you could use the Excel present value formula. It's potato, potato. All right. But here's the key point. 5 years of free cash flow, added up, present value. That's the value of the first 5 years. Year 6 going forward, it's called the continuing value period. What's Starbucks going to be worth long-term after year 5? Because it's not going to just go away after year 5. The formula that we are going to use for continuing value, back to our lecture notes. Here's the lecture note. Close that Excel file or a PowerPoint file. The formula that we are going to use is this one. That's the formula for continuing value. It's the key value driver equation. Okay, so just so I can reference this for you guys to see it, I am going to take a little screenshot of this key value driver equation. And I'm going to put it right here. In our model. Excel files open. All right. So basically what I've done is I've taken this screenshot of the formula and I'm putting it in our model. Just to remind you of what we're about to do. Back to Zoom and share. That's that formula. We just screenshot it and put it into our Excel file. Okay, so here's the idea. What we're going to do is we're going to create a continuing value for Starbucks, which is basically cell B9 with those 4 values. We need a NOPLAT, we need a G, we need an ROIC, and we need a WACC. Okay. Now, because those numbers could change in the future for continuing value, I'm going to put them on our ratios tab. And I'm going to use, or sorry, the assumptions tab. And I'm going to use this to build that formula. There's the WACC, which means I need a continuing value ROIC. I need a continuing value G, and I need a continuing value G and what's the 4th one? ROIC, G, WACC. Oh, NOPLAT, continuing value NOPLAT. So I need usually put the NOPLAT first. So continuing value NOPLAT, continuing value ROIC, and a continuing value G. And these are going to be yellow cells because they could change. So here's what we're going to use as placeholders. For the continuing value NOPLAT for cell B5 as a starting point equals from the TII, the final year forecast NOPLAT, M. That's the start of our continuing value period. So NOPLAT is row 5. So NOPLAT M5 off TII. 6692.7 is our starting NOPLAT. We can change it, but that's the starting assumption. Our ROIC. I need an ROIC for the final period. So what is ROIC in the final period? If I go to my TII I take my no plat in 2028 and I divide by my TFI, my invested capital in 2028, M8. That is my ROIC in 2028, 24%, if my forecast came true. And for G as a placeholder, we're going to use 3%. That is the continued long-term growth rate of a company. And the reason why we're going to start with 3% is most companies, when they're mature, tend to grow with the economy. US economy tends to grow 2 to 3% long-term per year. So therefore, we're going to use 3% growth. They're going to say you grow kind of with the economy. Again, we could change those assumptions later, but that's just the initial placeholder that we're starting with. So here's the point. Given these 4 values, we're going to build this formula. So here's the idea. Equals left paren, that formula right there. Left paren off the assumptions, no plat, which is B5, assumptions B5 times left paren 1 minus the growth, which is B7, divided by the ROIC, which is B6, right paren, divided by left paren, the WACC, which is B4, minus the G, which is B7, right paren, enter, 117 billion, 135.3 million of continuing value. This is the hardest thing you got to do tonight. That's the formula. It's on video. If you need to pause, look at this later. But basically, you got to get that formula into that cell with the correct order of operations. So basically what we're saying is Starbucks is going to create 15.8 billion value in the first 5 years of free cash flow and 117 billion of operating free cash flow value for year 6 into perpetuity. But the problem is that's at the beginning of year 6, and I need to present value that. So because year 6 has already been discounted, this is the beginning of year 6, I use the same discount factor, basically discount it 5 more years to bring it back to today. That times this, because I don't want to double discount that year 6. So my operating value of Starbucks, value of all its free cash flows in present value, today's dollars, is the first 5 years plus the continuing value, or $92 billion worth of operating cash flow value is what we're forecasting for Starbucks if our ratios and assumptions come true. That's the operating value. Now, very quickly, because we have 6 minutes left, I just want to get it done. You can look at this part of the video. Non-operating value. Here's where we go with TII. Equals off the TFI. These are the 3 non-operating assets: excess cash, non-operating assets, long-term investments. We've already rearranged them. So A10 through A12. What we're going to do is we're going to use today's values. Equals the last reported value for excess cash, G, TFI, G10. So G10, 11, and 12 are the non-operating values. They're already in present value. And the idea is non-operating values don't grow more than NPV 0 over time. Companies aren't good at it. So whatever non-operating value today, we assume they go forward. They're today's values. They don't change. Meaning, think of this. 2.5 billion of cash is worth 2.5 billion of cash. Long-term investments may change in value, but if they're not good at making long-term investments, they shouldn't change that much. Same thing with non-operating assets. So these, we just use the current values and they're already in NPV. They're already present value. So this is the non-operating value of Starbucks. Sum these up. Negative 1.4 billion Operating plus non-operating equals enterprise value. Enterprise value equals operating value plus the non-operating value. All right. Take the enterprise value, go to TFI, pay off all the debt, retirement-related liabilities, and interest-bearing debt. Pay off the non-common shareholders equals from the TFI. Pay off the preferred shareholders and the minority shareholders. Once those four stakeholders have been paid off, you will be left with a common equity value. Retirement-related liabilities, what we owe today, 2022, 0, but that's cell G15. Interest-bearing debt is G16. Preferred shareholders equals from the TFI. G17 is common, so G18 is preferred, and G19 off of TFI is minority. If we pay off all four of those stakeholders, decimal place, equals enterprise value minus the sum of those four things, that gets us a common equity value. If we divide that number by share count, we get share price. So our final number here is shares outstanding. Common equity value divided by shares outstanding is share price. Now, here's the thing. Shares outstanding is going to change by company. So I'm going to make this my next assumption. I'm going to make that yellow. And for Starbucks, their current shares outstanding right now, Bloomberg, as of today, their share count is 1,146.4 million. 1146.4. 1146.4. That is Starbucks shares outstanding today. So equals that number. Share price equals common equity value divided by shares outstanding, $58 a share. So if we were to say these cash flows came true, then what we would say is Starbucks is worth $58 a share. Today, Starbucks is trading, they closed at 101 and change. So what we're going to do next week is we're going to take this model and turn that into a $101 share price. Because the market doesn't think these ratios are going to be constant going forward. They think they're going to change, probably improve. And we're going to figure out how much they need to improve to lead to that share price. That will be what we'll work on during class next week. That'll be the other side of the valuation. Okay. But today, I just wanted to have the base model so that we can have that dynamic modeling conversation next week. So in order to get there, you got to have this. This is your homework assignment for next week. So two things. If you were able to do everything that we did in class, you've completed next week's homework assignment so that you have everything, including a share price of 58.38. If you haven't, you need to get to this point and upload this Excel file for our class next week. That's it. That's your homework for next week. Okay. So, but you've built, if you built this, you built all the chassis of the reusable valuation model. That's real in the real world. Like this model was used. Okay. So questions before we wrap up, because I know we're right at time. I'm not posting this file. You have to create it. I posted the start file. Hopefully you were able to do so. If you're working in pairs, you could work as pairs to turn it in, but nonetheless, you have to turn this in. All right, your final step for next week. So there's two parts to your homework. Part one, individually, make sure you create the model that matches this. I'm going to post the YouTube video next 30 minutes as soon as it finishes processing. The other thing is talk to your teammates, pick a company. So sometime this week, send me an email saying, I am team whatever. On behalf of your team, we want to value this company. That's our group project. And I will start putting data for that company in the file section under that company name. And this model is going to be used as part of the group project. So we're building towards that. All right. So other than that, there are no other final words. It's been a long day. I will see everybody next week. So good luck finishing up this model. No
Thank
write-up.
Thanks, Professor.
All right, see you next week. Bye.
Thank you.